Okay, just in time. Good morning, everyone. For those of you who do not know me, my name is Sebastian Edwards, and I am the faculty director of the Forecast, replacing the irreplaceable Jerry, who replaced the irreplaceable Ed Limer. So it's a chain of irreplaceable people that I am trying to replace. Some of you may have taken my classes in the past. I've been at UCLA longer than many of you have been alive. I arrived here, I don't even know how to explain it, but several years before LAX was refurbished for the first time. When I arrived here, LAX did not have two levels, one for arrivals and one for departures. There was only one, and it was even worse than today. If you can imagine how that was. I lived through an LA Olympics. We're going to live through another one. I first came to the economics department, and then we decided they did too much math and not enough applied real world stuff. So Ed Limer and I moved here to Anderson. And we've been, well, Ed passed, unfortunately, but it was a very good run. And we were able to get an excellent group of colleagues, including, of course, my colleagues that are going to present today. So I'm supposed to read a list of our supporters, which I always forget to do. So I will do it right away, and then I'll say a few more things about today's program. So at the principal level, RSM, Yamava Resort and Casino at San Manuel. The platinum level, the law firm of Allen Watkins, Cathay Bank, Federal Home Loan Bank of San Francisco, Mercury Insurance, and University Credit Union. Then at the gold level, Alaska Airlines, Bank of California. I love Bank of California. It's B-A-N-C. I think that gives it a lot of cachet, right? It sounds like French, but the French don't write bank that way either, right? Bank of California, Hub International, Leap Development, Newmo, PNC Bank, Robert Half, SMBC, Manu Bank. Silver level, Marsh McLennan, McCarthy Cook, U.S. Bank Private Wealth Management, Wilmington Trust, bronze level, Accutive Securities, Citizens Private Bank, Columbia Bank, Gensler, Hanmi Bank, HDR, MBK Real Estate, the Port of Long Beach, Q2, Shawmut Design and Construction, and at the brewing level, GCX, JLL. I don't know what those mean, but we're thankful that they are supporting us, and Suffolk Construction. So if you or your institution is not in this list, this is a great opportunity for you to talk to Seth. Seth, where are you? Say hi. That's Seth, the best dressed person in the room. That's Seth Katz. He is our executive director. So it's a great opportunity for you to talk to him and to join our group of supporters. Members of our board, so among supporters, we have a board, a great board. We have fantastic events. About a week ago, or a week and a half maybe, we had a dinner in Beverly Hills with the president of JP Morgan for the Americas, except the US. So meaning that he runs Canada and from Mexico all the way south to Patagonia. It was a fascinating conversation. And at the end of it, he's of course a UCLA grad. He was my student many decades ago. And at the end of the conversation, we were really wondering when was he going to take over the US part of the Americas, because he was incredibly, very, very impressive. He came here to talk to us and also to visit with his son, who is an MBA student. So we have been building across many generations students who send their kids or convince their kids, or the kids decide that this is the place to be. So if you want to talk to this, and that was that event was the Chip Robertson lecture, and we're very thankful to Chip for doing that. Okay, so today we're going to have our forecast. It is centered on real estate and that kind of thing. It's going to be very interesting. So many of you come to our events regularly. So what has happened between then and now? Lots of things, of course. But let me mention just a couple of them that I think are of great interest. The first one is that the Fed has a new chair. We talked about that the last time. We were unsure of how that was going to develop from a political point of view. But now, as of last week, the chair of the Federal Reserve is Kevin Warsh, educated in Stanford. He was, in the rumor says, although I don't know what the truth, that he was appointed to lower interest rates, since this data on inflation shows that it is coming up, and the likelihood that interest rates will be cut in an aggressive way or at all during the rest of the year is pretty low right now. So I think that's going to be interesting to see. The Financial Times today had an article on page 2 pointing out that the ECB, the European Central Bank, is likely to raise interest rates. It's closing the gap. There's a significant gap today with our rates higher than those of the ECB. So we're seeing that on the interest rate side, we're not going to see cuts very soon. Of course, interest rates are at the heart of the real estate industry. They affect real estate loans, mortgages, cost of capital, and so on and so forth. So that's something to look at. News today, early in the morning, the White House is looking to reimpose import tariffs by 10% to a very large number of countries. As you know, the reciprocity tariffs were turned down by the Supreme Court. There are other legal recourses to implement the tariff policy, and we will see from Clement Board's presentation how that is impacting the economy, employment, and so on. So that's going to be a very interesting discussion. And as I pointed out yesterday, when we had our seminar, so I don't know how many of you know, but when we have the conference, we call this the conference. We're now at the conference. The day before, we have a seminar where we talk about the same topics, but in a more technical point of view. So we do a little math, and we ask about the models, and we ask difficult questions to our economists who answer brilliantly all the time. But I pointed out yesterday that to me, the most important development of the last few weeks is related to Goldman Sachs. Goldman Sachs on Monday released its model, a mathematical model with more than 28,000 observations, regressions, and all sorts of things which they have had for a long time, predicting the outcome of the World Cup. Okay? So the most important thing that is happening for the next few weeks, starting on Monday, is the World Cup. Okay? So our guest the other day from JP Morgan, Canada is in the World Cup. He doesn't run the US, but the US is in the World Cup. Costa Rica is in the World Cup. Many of his countries are, so he is among the JP Morgan bosses, the one who has one of the largest number of countries in the World Cup. So What does Goldman Sachs say? It says that the final, it's going to be Spain against Argentina. And Goldman Sachs, I like Goldman Sachs, but I think that they are often wrong. They say that Spain will win the World Cup. And I'm taking bets that they are wrong, that Argentina will win. So if you want to take on the bets, come and see me later. Okay, so without having said that, and having used exactly my 10 minutes that were allotted to me, I now turn to the program, and we first have our three presenters in this first panel. My colleague Clement Bohr, who's going to talk about the U.S., and then we're going to talk William Yu about California, and Spencer Callick, who's going to talk about real estate and about important things in general. I hope that he does not contradict me in terms of the World Cup. Go Argentina. Okay, take it over. Thank you.
Is this yours?
Yeah.
Thank you, Sebastian. And unfortunately, I will have nothing more to say about the World Cup. But that's because the best team is not even in it, which is Denmark. The title of this talk for the U.S. National Economic Outlook is One Inflationary Battle After Another. So that is a nod to the current, most recent Oscar winner, but it's also a very good description of what the 2020s has turned out to be, at least so far. So coming into the 2020s, we had the supply chain disruptions that led to an inflationary surge. Then Russia invaded Ukraine, which added extra inflation on top of that. Then as we came down from that and things started to normalize, we had tariffs which started pushing up inflation. And then just at the beginning of this year, when we thought that we'd seen the most of the inflationary impact from the tariffs, we were now in a conflict with Iran, which sent oil prices skyrocketing again. Right? And so I want to start out with looking at this rise in oil prices and the various derivative oil prices that come from the crude oil prices. So what I'm showing you here is the percentage change in these various oil prices from the beginning of this year. And you see that they vary from, on the lower end, diesel and regular gas at the gas station has risen by about 50% over the last couple months in price since the beginning of this year. But then you also have other oil prices such as jet fuel and heating oil, which have risen by more than 120% at their peak, right? And so if you look at the benchmark West Texas Intermediate crude oil, that has risen by just about 100% so far this year. This has been announced, and it is on a daily perspective, the largest oil supply shock in modern history, at least. It's a reduction of 10% in the oil production per day. But that is not the right perspective to look at it. You shouldn't look at this from the daily perspective. You should look at it, well, how many days is this then going to be disrupted, right? So if it's going to have to match the oil supply shocks we had in the 1970s, it needs to be a fairly long-winded disruption. And at least so far, there's been a lot of optimism and hope that it would be a very brief disruption. That has not happened yet. There's still optimism that there will be the Strait of Hormuz, where the disruption happened, which was closed, will open up soon, but it's very uncertain. Right? And so what I'm showing you in this chart is three different potential pathways where the yellow dashed line shows that, well, if we have a truce and an opening of the closure of the Strait of Hormuz relatively soon within this month, oil prices will come down fairly quickly this year. But, and more aligned with our forecast, we have the Strait of Hormuz remaining closed at least for another couple months through about midsummer. And there you can see the oil prices will remain where they are, maybe rise slightly over the next couple months before then coming down. But that being said, it's very uncertain. And so far, there appears to be very little daylight amongst Iran and the US in terms of what this peace deal needs to look like. And so if this strait stays closed for much longer, we could actually start seeing even higher oil prices than what we've seen so far. And the reason for that is that I told you guys that the oil production or supply every day has decreased by about 10%. Well, we're still consuming more than that decline of the 10%. And so the world was flush in oil inventories before the strait closed, and we've just been drawing down on those global inventories in oil reserves. And at some point in the late summer or fall, these are really going to be starting to scraping the bottom of these inventories, in which case prices have to rise much more to actually bring demand and consumption down to the levels that we're producing it. And so that's going to lead to even higher oil prices if the strait stays closed for a significantly longer period of time. And so with that oil price shock that we're happening now, I already mentioned the 1970s because that was the other decade where we had a sequence of large energy supply shocks that in that decade, and that's what I'm showing you here in yellow, led to an inflationary surge where you see there were two large inflationary surges, but even when they came down from these large inflationary surges, inflation stayed very elevated at the time. And so the question is, well, how do we compare today at this point? And that's what I'm going to show you in the dark blue lines here. So this is the inflation through the 2020s. The first hump was the COVID-19 inflation. And then you see in 2026, we're just about creeping up on a second hump. And so you can already see from this chart that we are not in as severe a situation as we were back in the 1970s at all. First of all, these humps have been smaller. This next one is also expected to be smaller, although there's a lot of uncertainty there. But also crucially, the baseline inflation rate has stayed much lower throughout the 2020s than it was in the 1970s. And that has to do with inflation expectations. So back then, through these inflationary surges, inflation expectations rose throughout the decade, which fed into inflation itself and kept it very elevated. But through the 2020s, the inflation expectations have stayed very stable. The US still has a very credible central bank that has anchored inflation at about 2%. So even you can see through the COVID-19 pandemic, inflation expectations barely budged. There was an expectation that we would get over this and get back to 2%. The question is, will this continue? And so far, inflation expectations, even though they've gone up slightly for the long-term inflation expectations, they look very stable still. Right? So that is the good news. What I'm not showing in this chart is what it means for unemployment, because if you did live through the 1970s, which I did not do, unemployment skyrocketed through these two inflationary surges at the time. Right? And we do not expect that to happen this time either, partially again, because so far the disruption is smaller than what it was back then. But the other reason is that, first of all, the US is much less oil intensive than it was back then. After those energy crises back then, we diversified our economy towards other types of energy sources. And so we're much less dependent on oil than we were back then. And the other reason is that we're a net exporter of oil now. So actually, when oil prices go up, on net, the US becomes richer. Right? Now, those riches fall to the oil producers and the few people who own those firms. For most households in the US economy, this is a very harsh shock to their cost of living. And so on net, it's still a negative impact, but it's not going to be as severe as it was back in the 1970s. So turning to something that actually has a little bit more of a positive spin on it, if you have attended these past forecast conferences over the last year, we talked a lot about the slowing labor market and the gradually weakening labor market. And that's what you see here from 2023 to 2024 to 2025, where you have the average monthly employment growth throughout those years declining to almost zero in 2025, right? And in 2025, you can see what was actually pulling it down. It was reductions in employment in the manufacturing, that's the purple sector, right? That has a lot to do with the tariffs. And also in government employment. That has a lot to do with the DOGE initiative at the beginning of this year. But then if you look at 2026, you actually see that things have started to look stabilized and even slightly recover since the slowdown in 2025. So far in 2026, we're actually looking at a slight labor market recovery, or at least a balancing, whereas before we were worried that this negative trend was going to keep going down and down, right? And so that didn't happen. And so the economy in 2026 already is looking more robust than what it did in 2025. Now, alongside this decline in employment growth, we've also had a decline in the growth of the labor force. And so those two are very closely connected. And the reason we've had a decline in the labor force growth, you can see, has been the shrinking of the yellow bars between these yellow and blue bars, where you see that they actually went negative in 2025 as well with these yellow bars. And the yellow bars is the foreign-born contribution to the labor force, right? And so this is not surprising that this happened in 2025, when we actually had negative net immigration in this country, right? And so that really meant that the labor force could not grow as much as what it had done in the past, especially back in 2022 and 2023, when we had a lot of positive immigration during those years after the pandemic. And very curiously, if you look at 2026, it's looking like a reversal, right? And so far in 2026, where we have data through April, you're actually seeing a large increase in the number of foreign-born workers entering the labor force. And you're seeing a substantial decline in the native-born part of the labor force, right? So the native-born comes from a decline in the labor force participation rate, not actually people dying or leaving the country, but retiring and the likes. But it is very curious to see this reversal. I want to encourage you guys not to read too much into it, because these data series on a month-by-month basis are very noisy, and we only have data through April. So this probably will moderate substantially. But it is already a very curious change in the labor market that we've seen so far in 2026. Now, turning to GDP growth, that's something else that's held up very well. It has gradually slowed along with the slowdown in employment, but overall, we've gone from about 3% GDP growth to 2% GDP growth in 2020, from 2023, 2024, over to 2025 and 2026. Here I'm showing you core GDP growth on a year-over-year growth rate basis and what contributed to that GDP growth. And that comes from, as you can see, I've split it into 4 or 5 different colors, where the light yellow and the light gray are the parts that are now declining. That is other investment. A lot of that, the light yellow one, that's non-residential investment. That's the stagnation in the housing market under the high interest rates, where we're not really seeing much growth and actually declines in investment expenditures there. You also see the light gray, which is government expenditures. Those went from growing the economy back in 2024 to actually being slightly contractive now towards the end of 2025. Again, that's no surprise with the current government policies. It's very much aligned with that. And you see the significant dip in 2025 Q4 that had to do with the government shutdown. And so that has reversed. You also see the light blue, that's goods consumption, right? That has really contracted over the last year. Probably also to do with the tariffs, which makes it more expensive to consume goods, which has made people consume less goods, and therefore that growth in goods consumption has declined. And then last, but certainly not least, the most interesting part of this graph is the widening dark yellow section of what is contributing to GDP growth. That is high-tech investment. That is nearly all the massive investment into the AI-related infrastructure by the big tech firms. And you see, so that has just been growing and growing, and we do expect this to continue to grow. So far this year, last year, the big tech firms spent about $450 billion in investment expenditures into data centers and the likes. Right? That's more than 1% of GDP, a huge amount. Already this year, they now, if you sum up their projections for this year going forward, that's going to reach almost $800 billion. So almost a doubling of their investment expenditures at already massive scales into this new technology. And the question then is, well, how much larger can it get going forward? And at least according to their own projections, not that much larger. Right? So if you look at their own projections for 2027, they're expecting investment in these high-tech fields to go and touch 1 trillion and go above 1 trillion. But in terms of growth rates, which is what we're looking here, right? Growing from 400 billion to 800 billion is a much larger expansion than going from 800 billion to 1 trillion. Right? So they cannot keep expanding these investment expenditures as much as they have in the past. And one reason for that is that they're already spending all the profits and revenues that they're making. They do not have more cash on hand to do these investments, and so they're going to have to go out and take out more debt. Alphabet just yesterday announced that they're actually going to issue more equity and bring up more equity to spend on this investment of about the tune of $80 billion. And so there just is a limited runway there going forward to continue expanding this, which means that you should expect, if you come to the next conference or the next two, that these dark yellow bars are going to continue widening, really being the backbone for US GDP growth right now. But there's only so much more that they can widen, and they'll probably start shrinking after that. Now, we have a labor market that's barely growing, close to 0% growth, and we have GDP growth that's growing at about 2%. And so to many people, that is a puzzle, because how can we have the economy growing without more people being added to the economy? And the answer is that we are seeing decent productivity growth in the US economy. right? We are producing more per worker, but we're not adding more workers. And what this chart shows is that that has been where we are right now, where productivity growth has been the long-run historical norm since World War II. So contrary to the popular belief that we're seeing this, unusual productivity resurgence, we're actually have recovered from very low levels of productivity growth over the last couple of decades to what was more normal levels of productivity growth. And so one reason why some people talked about an exceptional productivity resurgence is if you just look at what I've highlighted in the charts as 5 dots, those are the 5 most recent quarters in GDP growth and employment growth. And you see that they're right around, on average, the trend line, right? But if you pick out one specific point or 2 specific points and you pick out the 2 largest ones, it looks like you're seeing very high productivity growth in those quarters. But as I mentioned on the last slide, GDP growth numbers are very volatile quarter by quarter, and so it's important to see the signal under the noise and take an average over the last year or 2 to get a really good idea about where productivity growth is at any moment. And the answer there is that it's great that we've seen this rebound in productivity growth, but it's not exceptional productivity growth by any means. And so with all these things happening to the US economy, what has the Federal Reserve decided to do about it? At the end of 2025, they lowered interest rates by 75 basis points. That's 0.75%. That's what you see is that last slide down the hill towards the end of the chart. And the question is, well, what does this mean? Why, what effect does this lowering of interest rates have on the US economy? And so here I'm going to mark different areas in the chart in terms of whether that level of interest rates is going to be boosting the economy, whether it's going to have a neutral effect, which is in white, or whether it's actually going to be restricting the economy in red. And you see that the black line has now gone into the green area, meaning that this level of interest rates, if anything, is actually going to be stimulative for the economy. Right? So the interest rates right now are accommodative for the US economy, which was another reason why before the Iran war, we were expecting a very strong growth in the US economy in 2026. And the second question we can have is, well, is it reasonable that we should have interest rates accommodating the US economy currently? Right? So the Federal Reserve lowered this because they were very worried about the labor market in 2025 with the slowdown in employment growth. And so they wanted to support the labor market, and therefore they lowered interest rates. But there's also a lot of other stuff going on in the economy. Not least, now we have a large resurgence in inflation. And so what this chart shows you instead is I'm highlighting in blue and yellow, not whether the policy is accommodative or restrictive, but instead the tunnel now is a policy that would be appropriate for the US economy relative to where unemployment is and where inflation is. And then in yellow would be a policy that's much more concerned about inflation, and in blue would be a policy that you'd set if you're much more concerned about the labor market. And what you see is that we're more deeply into blue territory than we even were in the green territory on the previous chart. Right? And so the blue territory, as I mentioned, that is very much aligned with what the Fed said themselves. They were worried about the labor market. But is this now a time to be so worried about the labor market? I've shown you that it didn't turn out so bad, while inflation is looking much worse. Right? And so there's a real argument to be made that they lowered interest rates way too quickly and now have interest rates too low relative to where it should be to accommodate this level of inflationary surge that we have in the US economy. So this leads us to the US outlook. What do we have forecasted for the US economy? And I'm going to start with the unemployment rate. If you had been here in the previous quarter, we had this labor market recovery, which I already showed you some of, continuing with the unemployment rate fairly stable over the next couple of years, being around 4.3%. Now we have a slight uptick in inflation through, around in the next couple months it'll be stable, but then towards the end of 2026 it's going to start rising just modestly to 4.5%. That has a lot to do with this war in Iran. It's the higher cost of living that's meant that the households have to reduce their expenditures on other goods because they spend more money on fuel and the higher cost items now, which reduces demand in the US economy. And so that's why we now see unemployment gradually rising just marginally, but overall still a very decent labor market. Now inflation we have going to 4.5% this year. It's already at 3.8%. It'll probably get up to 4% in the next inflation reading for the month of May. We have that peaking at 4.5% later this year. Right? And so that is basically just a direct effect from the higher fuel costs. If fuel prices have risen by 50% and fuel makes up 3% of your consumption budget, well, that directly feeds into inflation at about 1.5%. So there it's already baked in the cake, most of it. There is a lot of uncertainty about this inflation forecast in that it very much depends on when the Strait of Hormuz opens and oil prices come down, right? So if the Hormuz Strait opens up magically tomorrow, perhaps inflation will only peak slightly above 4% instead of 4.5%. Right? But if we're in a much worse situation where the Strait stays closed for an extended period of time through the fall, inflation could go much higher than what we also have forecasting here and even go above 5%. Right? So it's very uncertain what the inflationary forecast is. But one thing is for sure, we are at the start of an inflationary surge, right? And we've already seen that in the two most recent readings of the inflationary monthly reports. And so what does that mean for interest rates going forward? Sebastian Edwards already hinted at this, saying that it's probably very unlikely we're going to get any interest rate cuts coming soon. What I'm showing you here is the yield curve, past and future forecasted ones, where the yield curve is the interest rate at different maturities of US debt. So you have the federal funds rate, which is the overnight interest rate. Then you have the 5-year interest rate, the 10-year US government interest rate, and the 30-year interest rate. And each line is a different time period, where the blue was the previous ones in January, and then you have the yellow ones, which are the future forecasted yields. And what you see is that for the federal funds rate, we have no forecasted changes in the interest rate that the Federal Reserve sets. So I already argued to you that if anything, the interest rates are already too low. Many people think that we will be actually getting interest rate hikes, and that is a distinct possibility. But it's also a very distinct possibility that the Federal Reserve will just try and hold the line. And if this supply shock is temporary, wait through this temporary inflationary burst and then start lowering interest rates on the other side again. Now, Kevin Warsh was also hired for this job to bring down interest rates, and that's going to be very hard for him to do at this moment. And so he has an extra incentive, at least just to try and get some consensus on holding the line rather than raising interest rates. But it's very uncertain. This could really go, we won't see any interest rates cut soon, but we could see interest rate hikes, or we could see no changes in interest rate going through the next 2 years, and then a lowering of interest rates after that if inflation does come down as expected. If you go to the financial market futures, they are pricing in 2 interest rate cuts towards the end of this year. 2 interest rate rises towards the end of this year. Yeah. I saw some head nodding. I'm like, oh, wait, yeah, no.
Wait for it.
And so lastly, to look at the forecasted GDP growth, as I mentioned, before the war in Iran, we were really expecting an acceleration of the US economy in 2026. And so because of that, we still expect decent GDP growth in 2026, and that's on the back of all the AI investment expenditures. That's on the back of the One Big Beautiful Bill and the fiscal stimulus from the tax cuts, and that's on the back of the lower interest rates because of the cuts we got towards the end of last year from the Federal Reserve. So with all those things in mind, despite the negative effects from the oil supply shock, we are still expecting not great GDP growth, but decent GDP growth in 2026, around 2%. And so I want to end up with the risks to the forecast, which are, as usually, but even more so than usual, quite large. I've already spoken a lot about the Iran war escalation, right? That could happen. That could send prices even higher. If the Strait of Hormuz stays closed for a lot longer, that could make the forecast very different than what it is. We also have some financial market fragilities. Nobody knows if there is an AI bubble. There's good arguments on both sides, right? But even if there was one, you can't predict when it's going to pop. Right? The Greenspan, the chair of the Federal Reserve back in 1996, was talking about there being an irrational exuberance in financial markets then. It took another 4 years before the dot-com bubble popped. So you never know, even if there's an AI bubble, you cannot predict when it would happen, and it could be many years down the road. And then lastly, as Sebastian also mentioned, we are seeing constant churn in the trade and immigration policies with now the new tariffs put in place just this morning. And there was also an announcement of 25% tariffs on Brazil. I think it was yesterday or the day before that, right? And so in terms of this forecast, this is very much in line with what we expected, which is that the current tariff rates are going to stay where they are. These new tariffs that they just put in, which was 12.5% across 59 other countries in the European Union, They put those in because the previous 10% that they had put in across all countries had been overruled by a different international trade court saying that they had also been, put in place illegally. And so now they're just using another tool again to bring tariffs up to the level where they have been since the beginning of this year. So from that perspective, there's a new tariff announcement you should not think of as being a large change in what the current tariff policy already was. And so with that, I leave it to William.
Okay. Why don't we take two questions to you?
Okay.
And then so because I think that people may have urgent questions. So let's give. So I think that this is going to be different than from when we do it. So two questions now, then two questions to William, then we'll have Stanley add it up and then we'll have a conversation in general. So any urgent questions? If there are no urgent questions, we'll straight to William. Yes, urgent question over there.
Not urgent, just a comment. No elephant graphic this time with the pin on the balloon.
Okay. That was good, since that means that you've been keeping up with the graphs. Yes, over here.
So you had a slide that was, measuring productivity and change in productivity. Has your analysis, without getting too far into the weeds, but has productivity changed in how you calculate that productivity change? In other words, with AI or are you still using proxies to old school manufacturing to measure productivity?
No, so there has been a big change in how we measure productivity over the last 10 years or so.
Come to the mic so that I think they may be taping, and then pass it on to William.
So there has been a big change in how we measure productivity over the last 10 years or so, incorporating what's known as intangible capital and intangible investments, because that has to do with the whole shift to the software industry and the rise of digital computing, right? And so by now we have that fairly well figured out. Now you are right that perhaps AI is going to lead to have to do, another round of modifications, but so far those haven't been developed. And it's also unclear what new modifications would actually need to be done in terms of that, because we do at this point have a better understanding of how to measure productivity in a service economy. That being said, measuring productivity is very hard. Yeah. And we have to do a lot of imputations for it, and which is another reason why we like to look at long-run trends, because then we can actually see the signal under the noise. And so I just showed you, what the most recent 5 quarters had been in terms of productivity growth. This resurgence in productivity growth basically started around 2019, 2020 with the beginning of the pandemic. So it was really that the readjustment and recalibration in the economy that happened after the pandemic that led to this resurgence in productivity. And the question is now, will AI in the future lead to even higher levels of productivity growth, right? And so that could very well be, but at this point, it's speculative.
Let's pass it on.
All right. Oh, there's one more. Yeah.
How does housing and durable goods factor into your forecast as it has in past recessionary periods?
Yeah, so we're in a very unusual spot with the housing market, which is that Ed Leamer, who was the past director here, famously noted that housing is the business cycle. Well, one thing is very certain right now, which is that housing is not the business cycle. The housing market has been dead in the water for the past 3 years and is not doing anything. And the economy has mostly been booming throughout that period of time, right? But we certainly do not have a housing market recovery. In fact, if you go back 4 months from today, we were really hoping and expecting a housing market recovery over the next couple of years as interest rates came down. Now you see interest rates are rising again. Just give you an example, the 30-year fixed rate mortgage on average, right before the war in February, that had finally come below 6%, right? And that was really going to narrow that gap between what people's existing mortgage rates were and what they actually could get in a new market that would actually get people moving and the housing market uplifted again. As soon as the Iran war broke out, and over the last 2 months, that spiked up by 50 basis points, and now mortgage rates are around 6.5% again, right? And so that really just dampened any expectations for the housing market to recover. So we're not expecting the housing market to, say, lead to a recession because it's already itself in sort of recession territory. It's just the rest of the economy is looking so good relative to the housing market. But we're not expecting it to lead to a rebound imminently either. Yeah.
Let's.
Yeah. Okay.
If we go
yeah. Yeah.
William.
Okay.
talk about the housing market. Then we'll open.
All right, good morning, everyone. So I'm very excited to talk about the California economic outlook today. So first of all, let me give you the big picture of the current state of California economy. So in these slides, I would like to show you two most important macroeconomic variables. So in the chart, you see this blue line represents the year-over-year of the GDP growth rate, and the red line represents the year-over-year growth rate of non-farm payroll job. On the left is California, on the right is, on the left is United States, on the right is California. So we can see in the United States, and you can see usually the GDP growth rate are higher than the job growth rate, and they go hand in hand. So let's look at the United States. During the period of 2013 to 2019, on average, GDP growth rate is 2.5%, job growth rate is 1.7%. So labor productivity growth rate is 0.8%, all right? And let's skip the COVID disruption period. So let's focus on the recent 2 years, 2024, 2025. US GDP growth rate 2.5%, job growth rate 0.8%. So productivity growth rate increased to 1.6%, all right? And Clement already explained the possible reason why the labor market is so weak and why the labor productivity is higher. So right now, let's look at the California. So basically, you can just see the period of 2013 to 2019. The both blue lines and the red lines are higher than the United States. Indeed, looking at this period, California GDP growth rate is 4%, job growth rate is 2.4%. And productivity growth rate is 1.6%. Yeah, fantastic. So do you remember those good old times? During this tech boom periods, we create 5 out of the magnificent 7 big tech company, remember? All right, so moving to the current 2 years, 2024, 2025. In the middle of AI boom, in which California is again the epicenter, our GDP growth rate is 2.8%, and job growth rate slowed down to 0.6%. Productivity rise to 2.3%. So compared to United States, California GDP growth rate is slightly better, job growth rate is slightly worse. So right now, the gentleman just asked, right? What's going on about this? Is AI playing a role, right? As Clement said, it's too early to tell. But I think looking forward to the future, we need to be very careful what kind of California economy we are seeing in the future. Is this kind of economy, all right? I call it K-shaped economy. Or this kind of economy, I call it E-shaped economy. The E is a little bit slightly tilted upward, right? So in which you can see high income grow, middle income grow, and low income grow. Now, so you probably heard of K-shaped economy. Have you heard of an E-shaped economy? Because I just invented this term yesterday. Yeah. So Sebastian asked me to think of a term, so I think of this term. So if you had a better later, please let me know. All right. So, all right. So I think the key to whether we are gonna see this K-shaped economy or E-shaped economy depends on this very important development, and that is whether AI is gonna replacing job or AI is gonna complement human workers. So if it's a labor substitution, we're gonna see this more of a K-shaped economy. If it's more of labor augmentation, we're gonna see more of an E-shaped economy. So here, let me show you this combination of number of job, high-paying job in 3 sectors: professional business service, financial activity, and information sector in the United States. So basically, over the past 3 years, you see this kind of slightly decline employment in this kind of a job. So again, it's hard to tell what's in play. Maybe it's high interest rate, maybe it's over hiring during the 2022, 2023. Yeah. Okay, this is California. This white collar sector. We usually believe white collar sector share a lot of skill and tasks which AI can do. All right. So over the past, if we compare to the pre-pandemic peak, California white collar job had reduced by 200,000. So look at this. On the left, that is 1990s internet boom. We see huge white collar jobs growth in California. And in the 2010s, I told about this tech boom, we also see huge high skill job growth. And right now in this AI boom, we have not seen any kind of job growth. So that is concerning, all right? But put aside whether AI is replacing white collar jobs, I think the better explanation as far as we can tell is, especially for those big tech companies, in order to win this AI race, they need to use all their profit and cash to invest in this big AI data center, not on hiring new software engineering. Maybe that is the story. But for the record, our forecast, by the end, you are going to see, we are forecasting optimistic future, more of E-share economy for California economy. So right now, this is another evidence. So this is a job posting index by Indeed. So this ratio is comparing to the benchmark, which is in February 2020, right before the pandemic, within 100. So if this index right now, in May, if it is above 100, it means right now the job posting number for this category of job is higher than the pre-pandemic peak. So we can see on the left, like civil engineering, pharmacy, electrical engineering, education instruction, and so on and so forth, they had higher posting. So they are not impacted by maybe AI, and maybe they are boosting because of this re-industrial policy we are seeing in the United States. And going through to the right, you can see like software development, the index is barely 75. Yeah, so that means right now they are impacting probably by the AI. So right now, let's take a look at the payroll job growth rate for major metropolitan areas in the United States over the past several years. So in this chart, I show you both short-term and long-term growth. So the blue-green bar represent the compound annual growth rate of payroll job in that metropolitan area from April 2019 to April 2026. So it's like an average growth rate over the 7-year period. And the black line is just the average growth rate over the past 2 years period. So on the left, you can see high growth metropolitan area, like Raleigh, Austin. Austin is fantastic. For example, these are long-term job growth rate 3.5%. So it means every year they increase job by 3.5% compound for 7 years. So there's probably like a 27 increase of job. And then looking for, and then you can see Columbus, Dallas, Charlotte, Inland Empire. Inland Empire is a leading metro in California with the highest job growth. And then Houston, San Jose, Silicon Valley, although they are doing pretty well in the past 2 years, but in terms of over the past 7 years, they are not doing quite well. And then Sacramento. And all the way you can see like San Diego, Los Angeles County, Orange County, San Francisco, and other bi-coastal city, they are not doing quite well. Remember in the tech boom period, we call this city, bi-coastal city, superstar city. And right now they are falling angel, So I believe one of the major reasons which I'm going to show you is a cost of living, because they become the victim of their own success. High cost of living become the barrier of high growth. So here, this is the home price index by several major metropolitan area since 2000. And you can see over the past 26 years, most cities had a high home price growth. But for Los Angeles, including Orange County or San Diego, we had highest home price growth. Over this 26-year period, we had 347% growth in home price. San Francisco, 260%. And Chicago is the lowest, 130%. So basically, you can see in the 2010 tech boom period, housing price has become very expensive. But after COVID, it's even more expensive, more unaffordable. Yeah, so and so why is that? Why we are seeing this kind of difference growth rate for various demand and supply factor. So it's good for homeowner, it's good for investor, but it's not good for first-time home buyer or for the people who want to buy a house. So here, let me give you a very simple calculation of this kind of affordability issue. So in this chart, I show you this ratio, which is for median income household in a state in order to pay for the mortgage for a median price house in that state, how much they need to pay a month, a year. So in California, 50% of your pre-tax income you need to pay for this mortgage, given the assumption of a current mortgage rate, 10% down payment saving. Yeah. And then New York, Florida, and you see this 30% dash represents some kind of a ceiling of this affordability. And Texas, even like they had a high growth, job growth, they had more affordable housing in Texas. So right now, let me provide one factor why California is so unaffordable. And the reason is housing supply. So here I show you this annual housing supply building permit by 3 largest states. So blue line represents California, the red line represents Florida, and black line represents Texas. So basically, over the past decade or two, we have been producing less housing than Texas, half of that, right? So you might say, yeah, it might make sense because Texas had this kind of high job growth, high population growth, high immigration. So of course, they have to produce more housing, right? And you might know California, over the past 5 years, we have been losing population for the first time in our history for the past 5 years. So because we are losing population, so we don't have to produce so many housing. I think the better causality is opposite way, because we have not been producing sufficient housing. That housing becomes so unaffordable, so drive the people out of California. So that is the reason. So for example, here, let me give you these 2 indicators. So the blue line is year-over-year home price growth rate in California. You need to look at the left axis. So the black line represents the 0 home price growth rate. And the red line represents the year-over-year population growth rate in California. You need to look at the right axis. So the dashed line represents the 0 population growth rate. So let's focus on this period between 2020 and 2020. So in the early 2000s, you see, especially 2003, 2004, you see this kind of a home price growth rate skyrocket, right, to 20%, 30% housing bubble, right? And then we had this housing crash. So 2007, 2008, 2009. Did you see that in the middle of this Great Recession housing crash, the California population growth rate actually increased slightly, right, from 0.6% to like almost 1%, and stayed at kind of relatively high level until 2015. It started to decline. Why? One of the reasons is because, did you see the blue line again? At that time, we see this kind of higher and higher home price in California, driven probably by low interest rate. So that is kind of a reason I always argue more housing supply could make California housing less unaffordable and help stabilize our migration. By the way, I just show you this 100,000 probably new housing supply in California, right? That is almost like 1/5 of our government's goal, right? Our government say we should build 5 million more housing by 2030 in California, but we are not even close to that. All right, so here I show you this. This is a compound annual growth rate of the nominal taxable sales, like retail sales by county from 2019 to 2025. Because during this period, the CPI inflation rate averaged about 3.9%. So here I kind of color code. The blue color represent your real growth rate actually is below 0, and the orange yellow color represent higher growth rate. So basically you can see the inland counties with low cost of living, they had a higher growth rate, and coastal county like Los Angeles, Orange County, and most of the Bay Area, they had a lower economic growth rate. And here I would like to talk about another issue. So let's zoom in to the municipal city within Los Angeles County. You know, they all face similar kind of tax structure, regulation, cost of living. But this is the same kind of taxable sales growth rate I show you compared to 2019. So 2020, because of COVID, they had a decline taxable sales. For example, let's look at this circle. Beverly Hills, relatively well, right? Right now, they had a 20% higher taxable sales compared to 2019. Los Angeles City, did you see that Los Angeles City? It has been declining over the past 4 years. And Santa Monica actually is never increased over the past 5 years. So looking onto the right, you can see different cities have very different kind of different economic growth. Like San Francisco, actually also below the water for a long time. Until 2025, they kind of improve. And why is that? I think it's because of city governance. They realize the quality of life issue, or like homelessness or public safety, is very important for the local economy stability and growth. All right, so right now I would like to address another issue. From time to time, people talk about, you know, over the past decade, we see this kind of headline news, you know, some corporation moving from California to Texas because of high tax, high regulation, high cost of living, like Tesla, Oracle, CBI, Charles Schwab. Right? So I did this calculation to see how many headquarters by state. All right. So in this chart, the blue bar represents the number in 2016, and orange bar represents the number in 2026. So California is still number 1. In fact, during this 10-year period, we increased 2 S&P 500 headquarters. All right. New York City declined by 8. So Texas increased by 5. New Jersey declined by 5. Arizona increased by 5. So for California, we should not be worried. Maybe New York need to be worried about it. Yeah. So basically, I think the story is even like an established company, for whatever reason, they decide to leave California. But California, being a great ecosystem for tech company, they nurture new company. For example, over the past several years, we have created this S&P 500 company like DoorDash, Airbnb, Uber. And good news is we're gonna see 2 more next year. And these 2 are great ones, OpenAI and Entropy. Yeah. So here, let me show you the final slides. This is a headquarter as S&P 500 company by city, municipal city. Number 1, New York City, but they lost headquarters. And then we see Houston, Atlanta, Chicago, Dallas, San Jose. And you can see the map for California headquarters. Most of them are in Bay Area. 20 are in Southern California. But here, there's an interesting question. Where is City of Los Angeles? City of Los Angeles, being the second largest municipal city in the United States, we do not have S&P 500 headquarters. Actually, yesterday somebody asked me, say, actually, you are wrong. Actually, we had one. Yeah, let's just add it like December. It's a alternative as investment company. Yeah, but one is still very few. So we need to think about why is that? Is it because of business tax or other things? Yeah. So if we think it's important, then we probably need to try to change some kind of policy. All right, so conclusion and forecast. California had a stronger output growth but weaker job growth than the nation. Despite the AI boom, California is growing more slowly than its 2010 tech booms. High cost of living and housing is a barrier to its growth. So immigration, war, tariffs still weigh on employment growth in 2026. California is forecast to return to a strong growth from manufacturing, tech, construction, and tourism in the next 2 years. So you can see the forecast number. So basically, we are looking at a payroll job growth steady to increase over the next 2 years. All right, so that's my presentation. Thank you very much.
Thank you, William. So before we turn to Spencer, let's see if there are two urgent questions. Okay, over here. Where's Spencer? Right there. Oh, there you are.
Question for you, William. Thank
Yes.
you. That was great. The housing prices, whether it's in California, Texas, or whatever, does that include property taxes and insurance as an affordability index for housing or not?
No. That's another kind of burden. Yeah, that's right. You are right. Yeah.
We have been working, as you know, in the forecast on insurance and affordability and availability of insurance in California. And we hope to present more of those results. We're working with Mercury Insurance, who is one of our sponsors. So Williams' data does not do not include that.
Yeah, but in that sense, actually, because of Prop 13, actually California is more affordable in terms of property tax. That's true. Yeah.
We had the assessor yesterday, Jeffrey Prank. He was here and he told us lots of.
He's very happy because he's collecting a lot of property tax revenue.
Okay, one more question? Otherwise, we'll ask Spencer to come. Okay, one more over there at the very end. And then we'll ask Spencer to tell us what is really happening out there. He has the results from the CRE survey.
Thank you. My question is for your projections, William, for 2028 for employment and GDP growth for California, does it take into account the Olympics?
Yes. Yeah, that's right. Yeah, Olympics definitely will increase tourism job in 2028. But remember last time I presented, one kind of uncertainty is whether the exchange rate, because as I showed you last time, people usually forget this exchange rate play a role for international tourism. So we need to be careful about that. And that is nothing we can really control for.
So something that we will investigate is whether the exchange rate, so a strong dollar makes it difficult for people from Sweden or wherever to come. But the question is whether it discourages from coming or it changes the type of accommodations that they seek. And that's something that those are elasticities involved, and there may be different elasticities. Mm-hmm. Okay, Spencer, so why don't you join us? And while Spencer is coming over here, I want to remind you that how important the World Cup is. Germany won the World Cup in 1954, which is barely 9 years after the end of the war. It was a tremendous boost to the confidence of the German people. It was a country that had been destroyed. They had gone through a madman that was ruling them. The country had been divided in two, and winning the World Cup created an optimism. Consumers started spending, and the kind of things that Clement and William look at when they do their forecast happen because of optimism. So it's a lot of fun. it's a good sportsmanship, but also has a lot of economic consequences. Same thing with the Olympics. Spencer, so good to see you. Okay.
Thank you.
I will do the same thing with Spencer. He present his talk, and then we'll ask him urgent questions, and then we'll have a little conversation.
Good morning, everyone. My name is Spencer Kallick. I'm a partner at Allen Watkins law firm here. I'm the operating partner of our Century City office. I am also a land use attorney, so I'm intimately involved in all these aspects of real estate that we've been chatting about this morning. I want to be clear that I know nothing about the World Cup, and I have no predictions for you. I'm very excited because it is field day at my 7-year-old daughter's school today, and I'm scooping ice cream this afternoon. That's about all I know about sports happening right now in Los Angeles. But I do know about commercial real estate. And I have to share with you today, literally hot off the presses, our summer 2026 survey. For those of you who aren't aware, UCLA Anderson and our law firm Allen Watkins have had a partnership for many, many years looking at the sentiment of folks in the real estate industry as they're looking at different sectors of real estate and different communities and submarkets. And so this is literally off the presses. We just closed the books May 29th. And so you are seeing it first, and I'm excited to share it with you this morning. So overall, that changed? It did. All right. Overall, at the highest level, the survey points to a market with highs and lows. I think you heard our speakers this morning already chatting about it, but I'm happy to say mostly highs. There's a lot of optimism in the latest numbers across geographies and sectors. And not surprising, office in Southern California, still a little bit on a downturn. But for the first time in quite a while, there seems to be some agreement that real estate distress levels have hit their peak and are starting to come down or stabilize. This is important because anticipation of distress kept a lot of financing on the sidelines. For the life of me, I can't understand the economy. I'm not an economist. For those of you who have heard this before, I got a C in economics when I was in college. But all I can do is report the news and tell you what I see out there, which is deals are getting done. There's evidence in our Northern California numbers that, as you heard earlier, AI is triggering overwhelming optimism in all sectors of San Francisco and Silicon Valley, but especially in office and multifamily. In our winter survey 6 months ago, we saw an easing of external pressures, which I think is what economists mean by saying tariffs and interest rates. And in this survey, we've had some new external pressures, like you heard earlier, the war in Iran, and some old ones that are a bit intractable, like high interest rates and high construction costs. These are weighing on the market more than they did last year. So let's talk about multifamily. Multifamily continues to be one of the most resilient sectors in the survey across the state, except for Sacramento, where it's more borderline. When respondents say rental growth is tracking inflation, they suggest a healthier, more sustainable outlook than outside rent growth seen in earlier cycles. However, in San Francisco, Silicon Valley, respondents expect rents to increase faster than the rate of inflation. For those of you who are tracking San Francisco, you start looking at 20, 25% rent growth year over year. That's very strong rent growth. The expectation of declining vacancy still supports the idea that housing demand remains durable across many California markets, as you heard William talk about earlier. I can tell you from boots on the ground, in the last year, my team and I have entitled about 20,000 multifamily units across the state on my desk alone. Kelly was a part of a couple of those. Thank you, Gensler. But what I can tell you is very few of those are getting built, and that's borne out by the numbers that William shared earlier. There is some projects that are getting built in Culver City or Beverly Hills, pretty much nothing in the city of LA. By the way, I did not win 118,000 votes last night, in case you're wondering. That's a different Spencer. But what I can tell you is, I never thought I'd be making a Spencer Pratt joke in my entire life. But what I can tell you is leadership matters. And in places like Culver City or Beverly Hills or Santa Ana, for instance, where the city is very focused on not just approving a housing project, but actually making sure it gets built and holding the developer's hand through the process, That's how things get built. And we're seeing that in places like San Francisco, not really seeing it in places like Los Angeles at the moment. Industrial. I saw my buddy Sergio in the back there. He's working. If you're doing an industrial project, you're probably doing it with Sergio or Malcolm. Overall, industrial vacancy conditions remain among the strongest asset classes. Demand versus supply is mostly balanced, except in Southern California, where respondents expect demand to outpace supply. In Northern California, a majority of respondents are planning at least one new project, and e-commerce remains the dominant driver in California, followed by data centers, AI, and digital infrastructure. We're doing a bunch of data centers right now. It's super fascinating, both the actual data centers themselves, but also what I'll call adjacent projects. Like a client of ours does the cooling systems, like the AC systems for data centers, and they're flying off the shelves. They can't find enough space and build these things fast enough. I will tell you, there's obviously been some sentiment pushback of, hey, we don't want data centers in certain places, but in the right location, it's interesting. My prediction, hold on, data centers are going to be a huge bubble. I had a call the other day from a client who said, hey, I want to build a data center outside of Arizona, about 45 minutes north of Phoenix. I said, great. Looked at it, there's no water, there's no power. Not clear that they have any legal access to the property. I was like, yeah, I don't think this is the right site. And they're like, great, we're buying it, let's do it. I'm like, okay, that's when you know it's a bubble. Retail sector. So retail sentiment continues to be strong across California, and especially Northern California, and based on the Amazon boxes at my front door. 75% of respondents in Northern California are planning at least one new development, 60% in Southern California planning one new retail development. Developers continue to focus on neighborhood serving retail and service-oriented tenants. Grocery stores, fitness services are the anchors for these developments. Cost consciousness, and we've heard about inflation today, has led to a more targeted approach with strong focus on residential serving retail, as well as specialty stores in existing retail districts. The office sector, everyone's sexiest thing to talk about. Overall sentiment in the office sector varies across California, not a big shocker there. Developer sentiment is very optimistic in San Francisco. And I wanted to pause in San Francisco for a second, because I talked earlier about leadership as it relates to residential. In San Francisco, and this is public knowledge, it's been online, we just helped one of our clients buy, everyone knows the Oceanwide Tower in downtown LA, Graffiti Tower. There's also another one in San Francisco, First and Fremont, that's basically a hole was dug and then Oceanwide went away. So our client just bought the property. They're going vertical on a 60-story office building. And we called the mayor, Mayor Lurie, who, you've probably seen his Instagram videos and what have you. And we said, this is what we want to do. He came out the next day, brought his phone, met with us, said, literally anything I can do to make this happen, obviously nothing illegal, but like anything I can do to make this happen, I'm going to do it. And by the way, he filmed a video right there about it's the first new office tower going up in San Francisco in decades. And it's a spec office building, right? This is crazy that this is happening. 2 years ago, if I had told any of you to build spec office in San Francisco, let alone to like walk in the Embarcadero, you'd be like, I don't know about that. But now, because of leadership of one guy and a city that's behind him in this, people are investing again in San Francisco. And so I personally think that's what it's going to take in Los Angeles again. Don't ask me who I voted for. Not joking, I wrote in my dog's name. All right. The results from the latest survey are very similar to our winter survey when it talks about regional deep dive in Southern California. Retail sentiment improvements indicate better confidence in consumer-facing formats, particularly where retail is tied to daily needs in strong trade areas. Office remains challenging, not surprising. That's been kind of consistent over our survey over the last several years. Industrial still remains one of the strongest stories, supported by tightening vacancy and durable logistics demand. Multifamily also remains positive. I'd like to see some more starts myself, but there's definitely the demand. And the broader Southern California message is that it rewards sector selection and sub-market discipline, despite some weakness in LA and the Inland Empire office. The rest of this region is looking much healthier, and that's a good thing that our developers, our investors, are both small mom and pop to multinational corporations, are very focused on Southern California in the right locations and the right markets. Northern California. In NorCal, vacancy rates are expected to continue falling across San Francisco, the East Bay, Silicon Valley. In Sacramento, rates are expected to remain about the same. Retail sentiment being positive and improving suggests more confidence in consumer-oriented assets, with them many may assume, especially in the right locations. The office point is nuanced. Again, a lot of optimism in San Francisco and Silicon Valley, but that should not be interpreted as a full recovery. But it does indicate stronger belief that those innovation-driven markets are stronger in Northern California. Industrial in NorCal is outperforming the strong numbers in our winter survey. Multifamily resilience, again, brought on by those 25% rent growth year over year. We'd love 25% rent growth in Southern California. Overall, Northern California appears to be showing the clearest benefits where that innovation-driven demand and constrained supply remain intact. So, key drivers and challenges. On the driver side, you've heard it already, AI, data centers, digital infrastructure are becoming increasingly meaningful forces in the commercial real estate demand across all sectors. E-commerce remains foundational demand driver. On the challenge side, construction cost pressure has increased. See my friend Greg here. I know it's not easy since our winter survey continues to weigh on project economics and can delay or reshape those development pipelines. And then interest rates, as we heard earlier, stubbornly high, and the Iran war has increased inflation overall, which is causing some caution among our developers and investors. So that's it. Despite strong headwinds of high interest rates, inflation, and high construction cost, sentiment is pretty optimistic overall. I can say I spend most of my day either in person or on the phone with investors, developers, owners of real estate. For the life of me, again, I can't understand what's going on in the economy. I leave it to the much smarter people here. But what I can tell you is deals are getting done, deals are moving forward, very large, substantial deals. And so I remain optimistic. So that is very quick. For those of you who I haven't met before, I'm Spencer Kallick. If you're interested, check out the QR code. I started a podcast because why wouldn't you start a podcast in this crazy world? Called Real Smart with leaders in the real estate industry. Would love for you to check it out or maybe join us one day as well. Happy to take any questions. Thanks so much.
Okay, we certainly like to have some questions. Very interesting as usual. Yeah, let's get a couple of questions and then maybe the panel will have a short conversation. We're running a little behind. Yes.
All right. Well, thanks for your survey. Just wondering, do you see any deals happening as far as converting all the empty office? I know economic-wise, cost-wise, it didn't make sense, but now buildings are trading on pennies on the dollar. Maybe it does.
By the way, this is not a plug, but you are sitting next to the best person to talk to that about. Kelly at Gensler has done a tremendous amount of work on what is a good candidate to be converted. I appreciate the question. There was a time where every single panel I would speak on, everyone wanted to talk about this. And I literally went to our marketing people and said, I will not talk about this again because it just really is not happening. The city of LA did just recently pass their adaptive reuse ordinance, which there's starting to be some green shoots there. But to be very blunt, unless you are Dr. Lee in Koreatown who owns these office buildings at a super low basis, it really does not pencil. I hope that changes in time because we've got some amazing buildings across the city and across our state that need some love. But to be blunt, I'm really not seeing a lot of that right now.
Thomas, yes.
Thank you. So you mentioned the data center bubble possibility. And so I've seen research that suggests that quite a few data centers don't actually get completed, something like around 30% or something, which is quite a high percentage. And some data suggests that might actually be increasing. So I was wondering if you had anything to say on those trends or if there's any particular factors you think are relevant for completion rates for data centers.
Yeah, I have two answers to that. The first is money, right? These things are outrageously expensive to build. And the second is leadership. So, I mean, again, this is public, but I'm working on a data center for a client of ours in downtown LA at the corner of 7th and Grand. You would say to yourself, why in the hell would you do that? And the answer is because if you go underneath the ground at the corner of 7th and Grand, which I've done, every single data transmission line from China to the Western Hemisphere pops up at that intersection. People have heard of One Wilshire. It actually pops up basically at the doorstep of Bottega Louie, if you've been to that restaurant. And the answer is it requires.
We understand a lot of things.
There you go. Exactly. The answer is you need leadership, and you need cities who realize that if you want to have, I mean, I don't know about you, but I have like 10 different devices on me right now, and you want to drive your Tesla and you want to do all these other things, you want to have Netflix instantaneously, it requires you to have the data centers in the population hubs so that there's no latency, so that you can get, you can watch your, Love Island instantly, right?
The World Cup. The World Cup.
The World Cup. There you go. Exactly. The World Cup. And what I would say is the reason that I'm going to put aside the externalities, like you don't have water, you don't have power, like that's kind of a necessary, but it also requires leaders who realize there's a need for this infrastructure. It's almost as critical as turning on your spigot and water coming out now, that without it, we are not going to grow. It's why I think you're not going to see as many, Fortune 500 companies, as an example, located in downtown LA, where you've seen people who, companies that have left. It requires that in order to build the leadership and the truly infrastructure to be able to grow your economy and grow, get people who want to invest. Again, these things are like trillions of dollars. I mean, this one I'm doing in downtown LA is like a $5 billion investment. I'm not going to name anybody's name, but like there's zero opposition, and no one in this room is allowed to oppose what I'm saying right now. And we can't get leadership in City Hall.
So let me, this is what we'll do. We're running a little behind. We're going to cut short the break to 10 minutes. But I want to ask one question to the three of you. Spencer, you don't have to sit here.
Okay.
If you want to, you can sit.
Whatever.
If not, you can stay here. I haven't heard anything about the demographic crisis. If we're going to build houses, given how long it takes to get a permit and so on, maybe all these housing will be available when we have fewer people. So the more general question is, what do you guys think about the demographic crisis now? What is interesting, so William did talk that California is losing people. Projections are that the world is going to be losing people. China is going to shrink in terms of population. How do you guys internalize this issue, if at all, in your own conversation? So why don't the three of you, we start with William.
Yeah.
This way, and Spencer, sit here or stand there, or do whatever you want.
So my thought is California is different compared to other part of the United States. As long as we build house, there will be people coming to California from the rest of the country, from the rest of the world. Maybe they want to buy a second house, or like they buy it as an asset. So I'm not concerned about this population fertility for California, because this is a prime real estate. But it's very unfortunate, for whatever reason, we are not building enough house for all kinds of need, for basic housing, for the tenant, for this kind of international investor. So I'm not concerned for California.
US will move here.
Yes.
Okay.
So California is not Detroit. You are concerned about Detroit, right? Or the industry moving out, population loss, all those housing will become like a junk. But no, that is not going to happen for California.
So I'm going to have the same position as William, but broaden it to say that I'm not concerned about the US relative to the rest of the world. So if you look at projections for population over the next 50, 100 years, China peaked a couple of years ago at 1.4 billion. They're supposed to lose 400 million people by 2075. That's almost a third of their population. That's more than all the people in the US. I have no idea how they're going to manage that level of population decline. That's going to be an absolute disaster, right? But for the US, the projections is that we're going to keep growing in population because we're a high immigration country. People want to move here from the rest of the world. Of course, that could change. Right now, this year and last year, we were not a high immigration country, but historically, we are a high immigration country. So from the US perspective, if that trend consists, we are set up in a position where we don't have to worry about the decline in fertility rates around the world, because at the end of the day, everybody comes here.
Spencer?
I have so many thoughts about this, but what I'll quickly say is I'm an Angelino, right? Born and raised here. This is home for me. I care deeply about this community. And what I see right now is very little, and especially in the city of Los Angeles, getting done. It's taking too damn long to get anything done. I always say I'd be very happy to be out of a job. If you could replace me with AI or anything, great. Like I'll go do something else. Maybe I'll go, work for one of you all. But the fact that, I just got approval, this is public approval for a project for Heinz, large, multinational developer, 300, 400 units in the middle of Hollywood on top of a train station, right? No one's building that right now. No one's building a 35-story tower in the middle of Hollywood and, Gower. It's just not going to happen. And the reason is because it took 4 years. Okay, so fast forward. Now you've heard about all these new state laws. Front page LA Times, New York Times, California's gotten rid of CEQA. All housing's exempt. Kelly's laughing because it's a joke. It's not true. It's not a reality, right? Again, I see my buddy Evan Gordon in the back. Evan, we'd be out of a job if that were the case. The reality is sure, things have gotten a little bit simpler, but even if they've gotten simpler, there's just new roadblocks they're putting up. And all of us in this room, I'm going to assume, are pretty pro-housing, perhaps. And we all want to see housing for our kids to live. NIMBYs, good, excellent. Well, but we are in Westwood. I guess that's like the epicenter of NIMBYism. But what's fascinating is there's no consensus, despite what our legislature is doing, despite the fact that our kids can't even afford to live where we live, let alone in an apartment down the street that we're paying for. There's no consensus that this is a priority, even in Sacramento. So, I'll go to places where LA wants to build more housing. Great. Not going to get built. Culver City, Beverly Hills, maybe potentially going to get built. I'm doing a project up in Carpinteria right now. I don't know if anywhere up in Carpinteria. It's a beautiful place. They haven't built any new housing besides 5 ADUs in the last 30 years in that city, okay? And they've got a RENA requirement of 5,000 units. We're proposing 200 units, including 20% affordable, and you think that I was murdering every single man, woman, and child in that city right now, right? And it's fascinating because they all say to me, I have nowhere for my kids to go. I have nowhere for them to live. Well, I don't want 200 housing units on a vacant piece of property that was a farm. Like, this is the craziness we live in the state. So I'm a little pessimistic this morning.
You can see that.
But yeah.
Okay. Okay, so we're going to have a break now. It's going to be 10 minutes break. We're going to ring a bell when you come back, and we will continue with our program with Elizabeth. Thank you so much. Okay, thanks. Let's take our seats. I thought that was really very interesting. As I said earlier, we have a meeting the day before where we pretty much talk about similar things, although it's more technical. So I learned a lot of things yesterday, and I thought that today I was not going to learn much because I listened to most of the talks yesterday, and I already learned a lot. So it's very, very, very interesting. The one thing that, before I introduce Elizabeth, that I brought up yesterday, we spent a little time talking about, and was not mentioned today, is how within the United States, all of a sudden, Nashville has become a magnet of sorts. I've never been to Nashville. Probably I will never go to Nashville. But you may know that the Financial Times had a whole page saying that it is the only city worth living in the United States. If you want to, and so I know that Elizabeth has prepared remarks, but maybe you can tell us a little about why is Nashville. Even my daughter is talking about Nashville, and it's, to me, it's a little surprising, but there you go. So we are very fortunate to have Elizabeth Brink give us the keynote. She is the co-CEO of Gensler, which is a very important company. And she's been on the board and been there for quite some time. She is an architect by training, which I think is very, very important. To my eye, one of the interesting aspects of the LA, I'm not an expert on this, the LA housing market, in particular in some places, Culver City, Santa Monica, is that the architectural quality of the new buildings, it's quite good. And even for, I mean, we are managing or have managed some developers to build for affordable housing that are actually aesthetically pleasant. I can remember, I've lived in LA longer than many of you have been alive, but I remember really bad architecture. And that has changed a lot. And I think that the fact that people like Elizabeth, who are trained as architects now, have the leadership positions in real estate companies and so on is very, very important. So let me welcome Elizabeth and give her a big round of applause for her presentation. I put you on a spot about
Yeah. Well, Sebastian doesn't know this, but we do actually have an image of Nashville in this presentation. So you set me up pretty well. Thank you so much for the introduction, and thank you to the Forecast for having me here. It was an incredible morning this morning, and I'm actually really excited to be here at this stage because what I can do is really pull together some of the different threads that Clement and William and Spencer and Sebastian were really talking about, and do it from the perspective that we have at Gensler, which is we are builders and creators and designers. So for those of you who don't know, Gensler is a global architecture and design firm. We have over 6,500 people across the world, 56 offices in 13 countries around the world, and that includes about 1,200 people here in California in 6 offices. In LA, our office is downtown. And I will give a shout out. We have some really great Gensler colleagues here today. We love to come out and support one another. So it's great to have them here too. So in addition to design and architecture, we are also really focused on better understanding the human experience in the built environment. All of our creative professionals are incredibly curious about the world that they live in and really energized to make a difference and to create a better world through the power of design. That's our purpose. That's what we really bring to the work that we do every day. So through that, we have created our Gensler Research Institute. We established this in 2005, and it allows us to really dig into the questions about the built environment that make us the most curious. And this really informs what we do. So I thought it would be a really nice tie today with the economic forecast to be looking at some of our research and tie together a few pieces and threads from our research that again tie into what we were hearing this morning. So just to highlight a few of our really signature research pieces that we do every year, we do a global workplace survey. We're really the preeminent group that's looking at the human experience in workplace. We have started about 5 years ago, we started our City Pulse survey and have amassed an incredible amount of data, again, on the human experience in our cities from different perspectives. And every year we pull together information from all of this research, as well as from all of our practitioners around the globe and from our clients around the globe into what we call our design forecast. And that really sets the stage of what we're seeing that is going to be driving design forward, and that is going to be driving how we start thinking about our urban environments. So I'm going to share a little bit about that. Again, I'm going to share a little bit from a few of our different research efforts today and really tie that thread together. So in our design forecast, we have really surfaced 6 key meta trends globally that are driving design forward for the coming year. The first one is experience. This is really important. We are seeing an expanding importance of experience as the driver of value in the built environment, where people want to be going. I think this speaks a lot to what Sebastian's talking about with Nashville. It's an incredible example where the experience of being in that city is what pulls people in, what drives them. It's not just, the economic data or the job creation or housing costs. It's the experience of being there that is really the thing that is compelling. So we're seeing this across the board, where people are finding places where they go that they feel connected and inspired, where there's a sense of they can make memories there with the people that they're with, that they're connected to the story of a place. This is really driving value across the board. Second meta trend that we're seeing has to do with workplace. After the COVID era that we have come out of, we are now actually in the new workplace revolution. We talked about it for a number of years, but at this point, the workplaces that were designed with all the lessons that we learned from COVID, they've actually come online. And we're seeing what it means to really bring that learning in about well-being and hospitality and creating places that are real destinations and drivers of connection and innovation in top performing companies. And I'll talk a little bit more about both of those a little later in the presentation. A third huge idea that we're seeing is this idea of data, and not just the amount of data. There is an unbelievable amount of data out there, but it's really how are organizations able to take that data and turn it into intelligence? And how are they able to shape it and use it to allow them to see around corners? And once they can see around corners, it's organizations that have that built-in structural agility to transform based on that knowledge. So again, it's this pairing of data that can transform into knowledge and give you insights and the ability to act on those insights. We're seeing this is the way that so many companies are able to manage through uncertainty. Everything we talked about this morning, there's still so much uncertainty on the horizon. And so for them to be making the right decisions, whether it's about a large real estate portfolio or just managing supply chain on a project, managing market uncertainty, everyone's looking for how do we take all this data and actually turn it into something useful. The fourth, of course, there has to be an AI insight. And we talked about productivity. A lot of people are talking about job creation or job loss. What we see AI as an incredible tool to fuel creativity and to fuel insight. And that's how we're really seeing it in the design world. It's about having new tools to communicate much more early in the process, the creative ideas, to problem solve, to bring people on board and to test prototypes at an unprecedented rate. It's definitely speeding up the work, but it's actually creating a lot more opportunity to integrate feedback, to understand how people could be using the space, to run analysis of flow and possible use cases much earlier in the process. So driving sort of more creative energy into the process. Again, I told you I was very optimistic. We tend to be optimists as designers. But that ability to use AI is a real opportunity to create better spaces and better places. The fifth one that we're seeing is, and I'll talk about this a little bit later too, because we've already touched on it a bit, is the idea of building conversions and adaptive reuse and how our urban centers are really radically transforming because we are starting to see some of this. I know Spencer was saying we're not seeing any of it. Actually, around the country, we are seeing adaptive reuse in a number of different areas. And this is everything from transit hubs that are being used to civic centers to, I need to move the slide, thank you. Transit centers that are being used as civic and cultural venues to malls that are being transformed into universities. This is a hypothetical case of like a 90s atrium office building being transformed into a recreational center for pickleball, right? Of course, we've got AI and pickleball. We're hitting on all the trends in here. And the sixth and final meta trend that we're seeing is really about climate resilience. And designing for climate resilience is no longer an optional, oh, wouldn't it be great and nice to have and really nice for the planet? It's really much more about protecting our investments and creating long-term value of real estate investments. If a building cannot withstand the severe weather situations, it just doesn't have as much long-term value. And so that's the conversation around resilience and sustainable design has shifted. So those are our 6 meta trends that sort of set the context. And what I was going to go through in the next few minutes is talking just about a few of the areas that really relate to the discussion this morning. And especially where we're seeing, I know the theme of today was really about blurring boundaries. So some places where we are seeing blurring boundaries. So we will start with our cities. I think, we're talking about population growth. Sebastian brought that up this morning. There may be, population sort of shrinking in areas, but where we are seeing populations growing is in cities. That inflection point has happened about 20 years ago where we see more population in our cities than in our rural areas. And that just continues to grow at a really big pace. By 2050, over 68% of the world's population will live in cities. And so understanding that experience is really critical. And of course, as I said, we are all really curious people. And so when we see this kind of information, we think, well, okay, so what does that mean for our cities? How do we design cities that are more magnetic, that are drawing people in, where people want to be, that are going to be those kinds of spaces? What makes them be a place that people want to return to again and again? So in our City Pulse research, these are the cities that we found where people that are really drawing people into the cities. We do see Nashville down there. I'm going to keep going back to Nashville, but you start to see, what kinds of cities, what kinds of lifestyle, particularly in the US, people are really drawn to. And the importance of that is, again, of course, all the talent that's coming in, the tax base that's coming in, that comes into cities and spurs even more economic growth and vitality. So when we studied, it's really interesting. We studied what draws people to a city when we did that research. And what we found, unsurprisingly, it's like Maslow's hierarchy. The basics are the first thing. You need safety, security. You need to have economic opportunity and jobs. That is really what draws people in. So it's the financial and physical security that is that baseline that draws people in. But what's really interesting is when you start to see what is it that gets them to stay. And the cities that draw people in are not always the cities that people want to be staying in. And so when you want to get people to stay, it's really about how you feel about the city. We see here it's emotional connection to your city is at the heart of it, feeling proud, feeling like you belong, feeling at home. It actually goes to the World Cup. You talk about World Cup and pride in your country. That really goes to cities as well. Sports is an incredible driver for civic pride. And can be a driver for getting people to stay in their city, to have that kind of energy, pride. They want to, in fact, draw people into their city. So that emotional engagement, again, is that key driver. And you're not going to feel that if you don't have the basics, if you don't have the economic and physical safety. But it's so much more than that. And so you see what we're calling magnetic cities. These are the cities that people are staying in. They're not moving out of. So they have economic opportunity, but they also have that ability to keep you there. And, you'll notice each of these cities is very different, particularly in the domestic. Just for purposes of today's survey or today's conversation, we can focus on that. They're really different scales, really different geographies, really different economic basis, but they all have some mixture of things that drive pride, that drive safety, security, and drive some sense of feeling ownership. So again, yeah, I can send these to you. In the international one, yeah. Mm-hmm. No. Munich and Berlin. Yeah, World Cup. No, but it is very interesting, and there's a story I think behind each one of them. You know, and again, a different story. It's not that there is one perfect algorithm. It's how does the mix work for each of the cities? And so, of course, we looked at, you know, what's a downtown core. So one aspect of what does make a city magnetic is what's going on in the downtown core, the central business district. Or, you know, our office is downtown in LA, so we're really interested in understanding what's going on in downtown cores. LA downtown core is not doing so well. But the central, you know, the idea that the things that we started to find is that the downtown really does drive the reputation of a city. It's an incredible reputational driver, you know, because it's so visible, because it has so many people that go to it, and that it becomes almost like a brand ambassador. We also see that there is a huge perception behavior gap. So even when people like their downtown, they say it's a good experience, they don't go there. It's very hard to get people to go there for more than just running an errand. Even when in their brain, logically, they can be saying, you know, oh, I really like it when I go down there. So there's a 75% difference in our study between people, I'll show you some of the personas, between people who say they enjoy the downtown district versus do they actually go to the downtown or spend any time. That's the next one, dwell time. Dwell time is a huge driver of experience. What is it getting people to go beyond just running an errand and then going away? What is it that makes them want to stay and then have lunch and then go shopping or meet someone or, you know, add on to their experiences that would add to the vibrancy of a downtown area? Because what we see are if it's just people running errands, they go in, they go out, there's no vibrancy, there's no street life, there's no safety. They're all tied together. And the last one is after hours vibrancy, which we thought was very interesting. It's this idea of it's not just a 9 to 5 city. I mean, you all remember downtown back in the 80s, 5 o'clock, it was dead. And that's what, you know, it was really going on that was great in the 2010s downtown. It was starting to have that multi-hour vibrancy, and that's gone away at this point. But you really see that transforms a city and therefore can transforms a downtown and can transform a business district. So again, here are some of, when we looked at our research, just at a high level, the different personas that could use a downtown district. Everything from, you know, the short-term errand runner, right, who goes there short stays. That's actually about 42% of people in downtown areas. Very few people are actually the enthusiasts who stay for a long period of time. And then we have, you know, reluctant visitors and special event visitors. So they all have different expectations when they go into a city, but they all want the exact same thing. An overwhelming percentage all want a lively mixed-use district with housing, shops, and offices. They want it all. They want the vibrancy, and they want it, you know, after hours, 24 hours a day. So what does that look like? Thought we'd share some pretty pictures at this point. And there you got Nashville up there, Fifth and Broadway, an incredible project that is really a live, work, mixed use development, Class A office space, multifamily residential in the immediate neighborhood. And right around that is actually developing, you know, additional development is going on in that whole area, because that's where the bars, the restaurants, the office space, the residential, the people are there, and the amenities and experiences are all there together. You know, a few others that we see here, you even see in London, Fleet Street, right? A historic neighborhood. It's been around for a while. What they're doing now is really transforming the ground level, the streetscape, to create the parks and the retail that make it more of a 24-hour vibrant sort of civic area. So these are the kinds of spaces that are revitalizing downtown areas. You see Harbor Place there in Baltimore, another housing mixed-use development that's just groundbreaking. I think a couple months ago was groundbreaking that. All right, so talking about our cities, what the research really shows is that we can encourage more residents to stay, both in our downtown areas and our cities, by focusing on this idea of vibrancy and placemaking and emotional connection. And that is, partly where we get civic pride, where we get engagement, and where design can really be a part of it. Switching gears a little bit, tying again the other thread around conversions. We've been hearing a lot about conversions. Spencer was talking a lot about conversions of our built environment. And we're seeing that it's become really attractive across sectors. So we're seeing conversions in healthcare, in education, in hospitality, in mixed use. It's not always easy to do repositioning, but sometimes it is really an effective, cost-effective, and really resilient option. And you'll see some great examples. One of the things that we're going to be looking at too is specifically, I'll go into some of the office to residential conversions. So again, some more examples of incredible conversion projects that we've seen across the country. Just a couple that I will highlight. Frisco Public Library, it was a rocket factory in Frisco, Texas, that was transformed into this amazing library space that's become a civic hub and training center for the town of Frisco. You even see Willis Tower. I think everyone knows Sears Building, Willis Tower, Chicago. Iconic building, underutilized building as well. And by transforming and bringing in more mixed use opportunities, more retail into the space, more public open space, it transformed it into a really top utilized project. And last one I'll highlight too is one of my favorites in New York in Hudson Square, St. John's Terminal, which was an old train depot. And Google came in and redeveloped that into an incredible, groundbreaking workspace. But the whole floor is public, is open to the public. It's a public amenity with retail. The outdoor space has been turned into a wildlife habitat. So really regenerating that whole area of Hudson Square in New York. So just a couple examples. And I think I do need to speed it up a little bit. The office to residential opportunity is incredible. I mean, we went through this a little bit, talking again with Spencer. But with the office vacancies, it's really that opportunity between the housing shortage and the office oversupply. We know the benefits. It's not just benefit for the project, for the people that get to live there. It's a true benefit for our cities because it brings that level of vibrancy back into the city, stabilizes the tax base, and allows cities to really bring the downtown areas back. But it's not easy. And I think it was referred to Kelly and John. I will give a shout out to my colleagues, Kelly and John Arpey, who are real leaders in what we are doing at Gensler to help understand how to make these office to residential conversions work. But you have to look at a lot of different aspects to even understand whether a building would be a good candidate. You look at context. What does the floor plate look like? How can we service it? What's the form of the building? Does it make sense for residential units and how residential units need to be organized? You have to look at the building envelope, the window to core distance. Where are the existing elevators? Where are the existing windows? So to do an initial assessment, looking at the complexity of it is really useful, that early kind of screening. And I think, again, we've talked about the costs of doing these conversions. And then there's where do you get the value from, right? And we know there's costs, but you get the value from being in the right location, but also from having speed to market and having some incentives and cost incentives. And I think that Spencer was talking about leadership. Leadership can drive the ability to do this. It's not undoable. We just aren't doing it so well here in Los Angeles. I mean, even New York, which I'll show you in just a minute, they have a 90% tax abatement for any housing conversions that are 50 plus units. And you can see how that starts to impact their ability to be doing things. Boston has a 75% tax abatement. Washington, D.C. has a 20-year tax abatement. San Francisco has a transfer tax waiver and some other exemptions. So civic leadership can help make this happen, can really help it pencil out. Again, these are different ways that civic leadership could really move this forward. So I'm going to jump into New York. New York has had an incredible office to residential conversion boom. And it's interesting just to look at some of the examples. I will say just Gensler designed projects. We are currently under construction of 7,200 units in Midtown and the financial district in New York. So that it can be done, and it's being done in that city at an incredible volume because the upside is really big. I think that's a real driver in that market. So one of our favorites to talk about is Pearl House in New York. Just to give you an example, this project took a 1970s office tower at 160 Water Street in Manhattan, converted it into 588 apartments that are studio 1 and 2 bedroom units plus penthouses, about 30,000 square feet of amenities that include co-working spaces, wellness and fitness facilities, social lounge, rooftop spaces. It's really attractive to the demographic that's there in that financial district. This just underscores the complexity of doing these projects. Again, they are not easy, and that's part of the challenge there. We added 5 stories. We had to carve out vertical shafts for light. We had to add structural reinforcement, overbuild the facade. Again, it's a lot to transform these buildings. It's not you just put some new furniture in and they're ready to go. But it can be done. And, we start to see some other examples. Again, in Midtown Manhattan, we have the Pfizer building, which is a former Pfizer headquarters that is being transformed into over 1,600 residential units in Midtown Manhattan. In Philadelphia, the Franklin Tower is being transformed and adding 360 residential units. And in Toronto, transforming one St. Clair West into another property with 340 units. A little closer to home, in Denver, the Petroleum Building, a historic building, 14-story building, is being transformed into 178 units, 1, 2, and 3 bedroom apartments right in the downtown Denver core. And 101 Ash in San Diego, which was a really challenging civic property in downtown San Diego, is being transformed into 247 affordable units. So again, it can be done. It takes some leadership, and I'll go through these a little more quickly. Mixed signals here in downtown Los Angeles, right? We have, very high vacancy rates. We have a lot of buildings that could be some good candidates, and we did a study on that. I'll show you that in a little bit. We actually have pretty high residential occupancy, 90% occupancy in residential units, 90,000 people living downtown. We have great transit options coming into downtown, but you start to see safety, security, businesses are leaving. It's really, again, some mixed signals. They referenced this morning that the city passed its adaptive reuse ordinance. Great, but that's not all that needs to be done. It's a good first step. We really need building codes to change to allow for some of these buildings to really be viable. And we need those financial incentives. And, Spencer said, we're just not seeing the leadership owning this as an opportunity. And it really is an opportunity to add incredible vibrancy back to downtown. And by adding vibrancy back to downtown, we're adding vibrancy to the city. So again, give a shout out. Some of us at Gensler, along with some folks at CBRE and some other organizations, did a study for the city looking at 54 potential buildings. Through our initial criteria, narrowed down to 26. Pretty quickly, we could get that narrowed down to 26. Then we did more due diligence on those, and there are sort of 10-ish that are really being considered for conversion downtown that are really good candidates. And if just those 10 were converted, right, just taking that hypothetical 10, We could add 12 billion in assessed property value, possibly 2 billion in economic impacts to the city, 46 million in increased tax revenue, 16,000 jobs, over 16,000 jobs created by converting those buildings. The impact is worth the work. It's just hard to do. When you look at something like this, again, visually seeing what it is now and what it could be and the impact it could have on the vibrancy of the entire neighborhood is really tremendous. So I'm going to just click through some of these workplace slides because I had them and I know I'm definitely over time. But another place that we're seeing the vibrancy of cities so important is in workplace. And this revolution of bringing people back into the office is really important for civic health. But we have to make the experience worth the commute. It has to be a real destination. It's stabilized how people are working. And actually where we're seeing a little bit of change is people's working from home. It's now down to less than 1 day a week. And that's what's going down. They're still working in co-working spaces, business travel, sort of the mix is a little bit more dynamic, but work from home is coming down. And again, it's all about creating office experiences that are worth that. This is actually in downtown LA. It's our office in downtown LA. But who wouldn't want to go there? Who wouldn't say it's worth getting in the car and, and driving to go to that place? And you see, again, the blurring of lines. This feels like someone's living room or a really nice living room, nicer than probably many people have. But it's that residential feel that's coming in. This is in New York, JP Morgan Chase headquarters. And again, it's a New York version of the residential feel, but it's very much bringing people together and creating a space that they want to be in. It's not just about being at your desk and doing your work. And this is what is going to be transforming and creating that vibrancy in our workplaces that then drive the vibrancy in our city. Again, this is San Francisco, creating those kinds of experiences in Mexico City, experiences that feel local, that feel special, that make you want to come in and drive in. Again, who has this view from their apartment in New York City? Nobody. Who has a terrace that they can sit outside? No, they come into the office and they can have this experience. The other side of workplace that is really important right now is well-being, this idea of physical and mental well-being. And we start to see this is, again, another driver coming out of COVID that people are really excited about and what amenities people want. So it's everything from wellness amenities like bike racks and yoga rooms to the learning kinds of spaces and having these embedded. What you're going to see in our recent workplace survey, I won't go into detail, I promise, but learning spaces are incredibly important because actually those people who are using AI and using advanced technologies the most are those who are leading the learning and collaborative culture. So they're also the most engaged. They're the most collaborative with their team members. They're not using AI and just sitting by themselves and disengaging. It's actually the opposite. They're driving the rest of the culture forward. Those same people that are the power adopters of AI. It's an interesting sort of counterintuitive finding. For wellness, we're seeing much more use of space, outdoor space. Again, here's one where it's outdoor space and it's learning space, right at Lumen here in West LA. And again, outdoor space even in London. The balance between private space and open space is another well-being aspect that we're seeing in workplaces. Again, this is Edelman here in LA, but it's not just one or the other. It's really that balance and definitely includes private spaces. It's not these big open workplaces that we used to have. It's having these private spaces to take a moment. Again, that's St. John's Terminal and Human Plus. It's what we're calling the workplace now. You have to have a workplace that empowers and enables people to use technology. If we're using it as a creative force, as a way to catalyze that creative energy, other organizations are at well. And you see the difference between AI power users who are in the solid boxes are, anywhere from 5 to 12% more likely to be experimenting with new ways of working, learning something new, working really closely with their colleagues, having positive feelings about their colleagues. The correlation is incredibly interesting. And so that means spaces like this. This is actually one of the most advanced tech companies. This is their workplace. It looks like a living room because they're so focused on, we make tech products, high-tech products. We want our spaces to feel human. We need to nurture the human side of the people who are making the tech products. Again, so really interesting, counterintuitive strategy that they're using for their workplace. But again, it's the both and, the in-person and the technological. And it's really bringing all of that together into the experience that people are having. So I rushed through all of those workplace side of things really quickly. But just want to say thank you. We have QR codes for all of the research that I've referred to here. Please feel free to go on our website and download it all. It's all available for use for free. We're really thrilled to be sharing it with everybody. So I hope it tied together some of the pieces from this morning.
We're going to move to the.
Okay, yeah.
So thank you, Elizabeth,
Yeah.
so much. This was amazing. One of the best keynote speeches that we have had. It gave me a lot of optimism about the future. I'm now going to hand over the MC to my colleague, Tim Kawahara. Where's Tim? There he is, and he's going to run the panel. Tim, why don't you get here and just take over? And we are very much looking forward to the panel. Thank you so much.
Great, thank you, Sebastian. And I think you pretty much have the bios of these folks on, are these up on screen? Yeah, so I won't do too many introductions. I know we're behind, so we'll just try to get right into it. But I think we have a really great panel convened for you today. We have really literally every sector covered, I think. We have Capital A affordable housing with Jamie. We've got multifamily with Eddie, with Buddy. We've got mortgage lending. And then Oscar, who's the chief deputy economist for, I think, for CAR, California Association of Realtors, which I'll call CAR from here on out, just for short. But a esteemed panel, and obviously we can cover all the different sectors. But I thought I would just start with Oscar real quickly, since you are an economist, and we heard from the economist earlier today. Just in terms of what you're seeing in the home, everybody's always asking the questions, is it a seller's market? Is it a buyer's market? What's happening? But I'll start with kind of the geopolitics of what's going on in capital markets and shocks that are happening. And we heard a lot about unpredictability. Real estate markets don't like unpredictability, and things sort of seem to be frozen a little bit in terms of transaction volume and that kind of thing. But what are you seeing in terms of, like, for example, we finally dropped below the 6% for the 30-year mortgage. Then we have a war in Iran, and all of a sudden interest rates spikes. And this is traditionally a sales season. I think this is usually the hot season for single family sales. So what are you seeing from your seat?
Yeah, you're right. Typically, from April to August or September, that's the typical home buying season. But because of these uncertainty that we have heard already, I think everyone knows, that interest rates have gone up by about 50, 60 basis points since end of February or so. There's a lot of uncertainty. Now, despite the uncertainty, I think going into April, we thought, okay, well, everything is going to be, maybe a decline in sales. Price may actually be a little slow. But, with our April's number, we actually turned out to be actually flat compared to last year. Now, this is only existing single family home. When you look at new home sales, it might be a little different. But when you look at the existing single family home, it still fluctuated based on interest rate. Now, going into May, going into June, we could actually have some slow sales number because of the increase in interest rates. But for now, for our rest of the year, if we actually end the war in June, then we probably could see a flat year-over-year percent change in sales compared to last year. Now, if we actually go into August before the Strait of Hormuz open, then it might be a little different. And I'm hoping that interest rate will not go up to 7 or 8%, but we have had that experience before last year. Just keep in mind, interest rates, even though it's actually at around 30-year fixed rate at around 6.6-ish or so, it's still below last year's level. So I'm hoping that we can have a better second half of the year.
Of course, you have headwinds with affordability issues too, with gasoline prices and grocery prices and everything else too. So I'm sure that's factoring into your calculus.
Yeah, we looked at, a lot of different things. A lot of time, when people talk about housing affordability, the main thing is, of course, not just prices. We talk about rates as well. But when we look at housing affordability, we also look at household income. We take those into consideration. And believe it or not, in the first quarter of this year, based on our California Housing Affordability Index, it's actually a little bit higher compared to the last couple quarters. So we have had some improvement. That's not taking into consideration the increase in interest rates starting in the second quarter, though.
Yeah, we heard a little bit about affordability this morning, and we'll address that specifically. But William had a slide or two on there on affordability. You have an affordability index. Maybe you just spend a second telling us about that.
Sure. We have had this housing affordability index for the last 40 years or so. California Association has developed this housing affordability index. It's basically an indicator that shows how many people or percent of households in California or in a particular region that could afford to buy a median price home. Now, you would think, at 50, for a median price home, if it's in the ideal world, maybe about 50% of the people can buy a median price home. But currently, the housing affordability index, it is around 22%, which is below the pre-pandemic level at 33. So we have improved compared to the last 4 years.
How do you define affordability? Is it based on AMI or?
That's right. I should explain a little bit. It's basically based on 3 criteria. We look at the percent, like I said, the percent of household who can afford to buy. But then we look at, home prices. We look at interest rates. The main thing is looking at mortgage payment compared to how much people actually can pay. So when we look at household income and look at the mortgage payment, we get a better assessment at, how many people can afford to buy.
And then in terms of geography for California, markets that are hot or not, or where you're seeing activity, are you seeing any difference between, say, Inland Empire, coastal, northern, southern? What are you guys forecasting for the different regions of California?
I think housing market is similar to the economy, which has a K-shaped, it's kind of a K-shaped economy. If you look at the more affordable segments, you would think, okay, well, the more affordable segment, it should have a little bit more sales. But because of what's going on with interest rates, those affordability affect the lower household income a little bit more. So I would say, in the upcoming year, for the rest of 2026, we probably will see a little bit more activities in the higher income households sales transactions, which could actually create a facade that shows that the median price actually increased. But in reality, it's because the mix of sales changed a little bit.
Yeah, and then obviously insurance costs are spiking in California now too, if you could even get insurance. So how is that now factoring into decision making in terms of home buying?
Yeah, insurance is actually a big part of it. I think a lot of home buyers now understand that insurance has to be taken into consideration when buying a house. So when you look at some of the survey that we do an annual housing market survey on an annual basis. About 16 or 17% of our realtors actually experience a drop of contracts because of not being able to get insurance. I would say maybe about 4 or 5%, or maybe even 6 or 7% of the transactions, the buyers were actually a little surprised when they actually get into closing. But I think going forward, we probably will continue to see some of those, partly because we expect at a national level an 8% increase in insurance premium, but at the California level, about 16% or so.
Yeah, that's significant. Wow. Yeah, so people are factoring, and that is, like I said, even if you could even get insurance, I know so many people, we did a lot of work on the wildfire recovery.
Exactly.
Insurance markets really need some reform and big gaps. And, everybody thinks of the Palisades as being a wealthy community, but almost a quarter of those folks were on the FAIR plan, which is the insurance of last resort, and very underinsured. How about condo sales? We've seen a lot of headwinds in the condo sale market.
Condo sales, I think last year we had a lot of issues. It's not just insurance. Buddy probably can tell you about that.
Yeah.
Some of the issues, regulations in LA specifically.
probably pull back some of the sales in condos. I think we started seeing a little bit of pickup in condo sales, maybe in the first quarter or so, just because the fact that the last couple of years we have some slow sales. But of course, condo would be an alternative for more, the lower household income, lower income households to buy. But the fact is, of course, we're also really not building as many, as William said earlier. There's also a supply issue. So we're encountering a demand issues, earlier because of right now because of interest rates, but we also are encountering the supply issues.
Yeah, and William, we are seeing out migration. I think the number was 10,000 for LA, but when we're short 500,000 units in Los Angeles, I'm not sure how much of an impact 10,000 out migration is going to be, and housing is still going to stay really unaffordable here. That's a good transition to Buddy, and you're in the mortgage lending business. It's obviously critical to all of this. The interest rate environments, I sort of thought for me personally, the magic number was 6%. Once we saw the 30-year fixed go below 6, that it would kind of open the market. And then, of course, we had a war in Iran, and it's spiking again now. But, what are you seeing in terms of interest rate environment? What do you forecast? You think once the war's over, as Oscar mentioned, we're just going to go back down immediately? And
yeah,
we don't know when the war's going to end.
Yeah, I would agree with Oscar there as far as rates go. I mean, on the 30-year fix, we need to see it probably under 6. Right now, just in LA County, 77% of borrowers or clients that have a mortgage are under 5%. So you kind of get that locked in effect, right? People don't want to move. I mean, from a forecast perspective, I mean,
I don't want to move. I don't want to give up my 3% mortgage for a second.
Absolutely, right? I mean, it's double the house, right? I mean, just from affordability standpoint. So, so those are some of the things we're seeing. Obviously, the war, like back in February, before the war just started, we hit a 2-year low in interest rates, and you started seeing people refinance. And that's right when you got to that like 5.95, kind of the average 30-year. So, originations at PNC, about 50% of our pipeline went up to refinance. Now with the war, we're down to about 20%. So from a transaction standpoint, that's just limiting what people can do. And what we're noticing a lot, just from a product perspective, is just the difference in people going with 30-year mortgages versus adjustable rate mortgages. And right now, one of the most popular products for us is home equity lines of credit. Right? Because people aren't moving, but they still want to do things with their home. They need money. Credit card debt's at an all-time high. They need to have something to do. And equity's at an all-time high because we've seen home appreciation. So people are taking money out of their homes from an equity standpoint and using it that way to take care of their needs versus a refinance or, maybe even purchasing another property.
Yeah, we saw a lot of that using your home as an ATM, right, for a decade ago. But yeah, certainly a lot of that too. So originations, and I'm guessing, is down for across the board.
Yeah, I mean, we're flat from last year.
Flat.
Yeah, so we're flat from last year. What we're seeing is because refinances weren't really happening last year as well. So that's about flat when we anticipated about 10 to 15% increase. The purchase market right now is relatively flat as well. So transactions are flat from last year, but they were supposed to be up 10 to 15%. So, we keep on waiting for that boom, right? I mean, since 2022, and rates have risen. Everyone's, well, rates are going to go down. Rates are going to go down. And now we're in 2026, and I mean, we heard earlier, we have 2 more rate hikes, be an estimate for the rest of this year. So rates are not moving the way that people in the mortgage industry wants to see it.
And do you see any change in the capital markets and monetary policy in the 10 years? Is it any movement at all?
I mean, the 10 years up, 60 bips since the war started. The one thing that I have noticed, if you look at like where rates are today, it's about 6.61% on a 30-year fixed, right? That's up from the 6% that we were talking about a little bit earlier. But what's very interesting is if you look at like the mortgage spreads over the last 2 years, mortgage spreads have actually contracted, which is helping the mortgage market. Because if the mortgage spreads were what they were a year ago or a year and a half ago, we probably would be looking at about 7.25 versus 6.61. So, I mean, just that's something, I guess, if spreads stay where they're at and the war ends, and we'll see the rates go down. But I think those are all factors in with the 10-year as well.
So safe to say your borrowers are a bit on the sideline right now.
Yes. Yeah.
And then Oscar, the same thing. You're seeing slowing transactions? People are waiting to see what's going to happen.
Yeah, I think a lot of time it's not just about, interest rates. Interest rate is definitely an issue, but they're also concerned about the uncertainty of what's going to happen with prices. Let's say if they were to purchase a property and then it suddenly dropped, 3 months from now, they wouldn't want that to happen. So I think the people who have already determined to buy right now, the primary home buyers, they probably will try to buy. And that's what we are kind of hoping, that the home buying season will be stretched a little bit longer. But with no one knows when the war is going to end, it's really hard to predict.
Yeah, and even though your originations volume is flat, you're not seeing any distress in your portfolios?
No, not at all.
Okay.
That's kind of the difference between, if you look at the housing crisis that we had, many years ago, we're not seeing any delinquency, right? So, we're even talking about, and I'm hearing other friends at other places, at other institutions talking about this as well, is like there's more risk to be taken, right? Because especially when it comes to affordability, and you're also seeing people going alternatively with mortgages, meaning they're taking out some more non-QM loans, they're doing bank statement programs, because it comes down to affordability at the end of the day in a lot of cases. So, but from a distress standpoint, our delinquencies there are zero.
That's great. Why don't we move on to Eddie real quick and get a picture of what's happening in multifamily? Obviously, that's a critical part of creating housing supply across the nation. But, I know you're primarily, I think, on the West Coast, but a lot of multifamily investors are looking all over the country. I know there's been a lot of job growth in terms of labor market in the Southeast, for example. But in terms of geography, so what do you see generally in multifamily in your markets that you play in? And then where are your colleagues looking for yield in other parts of the country?
Yeah, thanks, Tim. So I think what we're seeing primarily right now, and this is like super, in the immediate data set of my own portfolio, our occupancies, we're only West Coast, so Seattle down to the Inland Empire. Our occupancy level is now at I want to say a four-year high. We're at 95% physical, 95.8 or something physical. Our trend is actually 97, if you can believe that. And so we're really excited, because the next thing after occupancies firm up is we're going to see a little bit of rent growth. And that's happening right now. It's happening in San Jose. We're doing really well starting in the East Bay in Fremont. That's actually the next kind of market that looks to be ready to start kind of, increasing. And we're excited about that.
Those are mostly tech jobs?
Those are tech adjacent. So
tech,
and then we supply workforce housing.
Back office stuff too.
Yeah. So we're, 1 or 2 rings out from the MSAs, kind of the, call it market rate affordable is what we specialize in. And then, with respect to the rest of the country and the investor sentiment, I guess. So a lot of folks 4 or 5 years ago decided that California and Washington as well is just it's too challenging. The politics make it too difficult to do business here. So we're just going to put all our money into the redder states where, you could kick somebody out for, blah, 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 and you could do this, you could do that. Well, if everybody thought that, then everybody went there and oversupplied those markets like there's no tomorrow. And everybody's looking backwards and going, well, at least California, we understand what rent control is. We understand what they can and can't do. And we sort of have learned how to navigate those the markets here on the West Coast. And we have the great challenge and social problem that we will apparently never build enough housing here. So you can't build enough. You got the number 1, number 2, whatever it is in the nation in terms of Fortune 500s. And yeah, you have a perpetual problem where the renter is going to be kind of caught in the middle, and the owner of the rental properties, hopefully, is going to do okay.
Yeah, the regulatory environment in California. Are you doing any ground up at all?
No ground up.
Yeah, good for you.
Yeah. No ground up.
The regulatory environment in California makes it incredibly difficult. It artificially keeps housing down, the supply down. You mentioned William, Texas. There's not a lot of regulation in Texas. You can build almost anything you want anywhere. And so Austin, for example, right now is getting crushed in terms of rental growth and vacancies. And So I don't know. You can look at it either way, California versus the rest of the country. But I do know, unfortunately, a lot of developers that they basically redline California. They've certainly redlined the city of LA and are no longer building. And of course, you add to that the ULA tax in California, which is, those of you that don't know, the voters put in a transfer tax. Any property it was called a mansion tax. So of course, stick it to the millionaires who have $10 million mansions. The issue is that it actually applies to all properties, all commercial properties, including affordable housing. So I think we're going to need some level of reform, but it's effectively shut down affordable housing development in the city of LA for sure. Yeah. And absolutely the worst time to do that. So we can talk a little bit about that more too. What about like cap rates? What are you seeing around the country and what are you paying?
So today cap rates, I think the big lesson that everybody realized is that, the cap rate is supposed to be an overall kind of proxy for all kinds of things, location and quality and, whatever, style of building, whatever it is, right? Durability of the cash flow. I think what we've all learned over the last 3 or 4 years is the institutional viewpoint on what a cap rate is interest rates. And so, unfortunately, when interest rates are so high, that kind of, dictates value to a lot of the institutional investors who grew accustomed to having positive leverage in their assets. You buy at a 6 cap and you finance it at a 4.5 cap and you've got a money machine. So that dynamic they got addicted to, that's not necessarily the only way to buy real estate. In fact, I think prior to, 2000 or 2002, it was all negative leverage. So the question is, will the cap rate actually ever get back to a real assessment of all things about the property in terms of value, not just interest rates? But right now, that's the driver. So right now we can buy something in the 7.5, 5.5 cap range and still generate an equity yield of somewhere in the 15 to 16%, return, depending on all the other factors. Unfortunately, a lot of sellers are holding on till, to that 4.5 cap property, which really only applies to certain.
Are you generally a buy and hold?
We are actually buy, renovate, sell, generally.
Okay.
But interestingly, we've now tackled 3 or 4 different projects, at least in the bidding stages, where we've been able to kind of derive almost a value add yield based on the fact that the investor appetite isn't there. So we can actually buy at a much higher cap rate for that cash flow.
So multifamily can be very competitive, but you're actually seeing a decrease in investor sentiment in multi.
Oh my gosh, yeah. Totally, yeah,
and
absolutely.
That's everywhere.
Everywhere on the West Coast that I can think of, yeah, for sure.
Yeah, excellent. And how about we've heard a lot about agency lending and the GSEs and what's going on there. Are they going to privatize Fannie and all this sort of stuff? I would imagine you use those products.
We do, yeah. We're Fannie borrowers and Freddie borrowers. Look, before the GFC, Fannie and Freddie existed as private entities with a, implied government protection. And it was really just an implied government protection. In 2008, I guess, when they actually did go under and needed rescuing, they became actual government sponsored enterprises. The question is can they survive on their own without the government? I think they totally can. I think that's not the issue. I think the issue is now that they've been taken over at some point by the federal government, will anybody truly ever believe that they wouldn't be taken over again? And therefore, the implied government kind of sponsorship of those entities will continue in perpetuity. Because I think that both of those groups are way too big to fail.
And you're principally sort of in what we call the workforce space?
Yes, workforce.
So, and what AMI are we talking about?
Well, it depends on the location. It's,
of course,
gosh, some of our properties are actually 10, 15% above AMI, still considered affordable. So I would say 80% on the very low end of AMI, up to 125.
Yeah, I'll be asking Jamie some of these questions, but there's a real conundrum with what we call the missing middle or workforce housing in California. We've got, some programs for folks with a very low income subsidies and government subsidies and that kind of thing. Obviously, a lot of the workforce can't compete in the fully market rate. So, what we kind of call our firefighters, cops, nurses, teachers, they're sort of in the middle, stuck in a middle ground, which is just really tough. So why don't we talk a little bit about Jamie is capital A affordable housing. So you're using things like tax credits and some of the things that are available that I just mentioned. Probably the area of affordable housing that probably the audience knows least about. It's a very niche, very complicated, very difficult to do, very high barrier to entry, as you know, Jamie. But maybe talk a little bit about kind of the business in general, how it's different than market rate, and in particular, the use of tax credit financing and bond financing and public subsidies that are available to build the type of product that you're building.
Sure. So we build affordable housing in conjunction with for-profit affordable housing developers. I run a nonprofit. We just closed 2 ground-up deals in California, which I think for a while that were really hard to find LIHTC ground-up deals in California. We use low-income housing tax credits. There's been recent changes to the federal rules on low-income housing and changes to those tests, which are supposed to create a bigger supply of affordable housing tax credits by lowering a limit of what eligible basis you need to free up bond cap. But in a market like California, where it's very, very competitive for these credits, you have pressure on pricing. There are only so many equity investors of low-income housing tax credits. And so there has been a big price deterioration. And what happens is when that price deterioration, there's less equity for those transactions. So you have some bonds that you are allocated as part of a 4% credit deal, and there becomes a bigger gap in the financing. You have high construction costs, big gaps in financing. So actually the last 2 deals that we were able to do in California, we used recycled bonds. So those are bonds that have been previously allocated, but they've come back before they are out. So they are not considered in the bond cap allocation. And I think that you're going to continue to see creative structures like that, because trying to put together a capital A affordable housing deal with all the different pieces of soft financing that are getting fewer and far between and honestly more cumbersome to the process and drives up the cost of the development. I think that some of these new bond financings are really interesting, and we'll kind of see. The change from the 25% to the 25% from the 50% test is very new. And so we'll see as that gets absorbed into the market, how that overall impacts housing starts from low-income housing.
And there's a 4% and a 9% tax credit. So
Correct.
difference. What do you guys?
So the 4% tax credits come along with a bond allocation. So they are viewed as less competitive. 9% tax credits, you're financing much more of your project through the credits. And therefore those credits are high. Like in our portfolio of 120 assets, we have 2 9% deals compared to all of our 4% deals. So we tend to focus on 4% transactions. We also do non-federally incentivized projects. We are doing ground up as well as ACT rehab with private financing. And here in California, utilizing a powerful tool in the welfare tax exemption. We're a national nonprofit, so we are working across 9 different states and kind of understand what the dynamics are between the incentives that are available, whether it be from on the tax side to create new affordable housing or to preserve existing affordable housing.
Are you also doing like historic tax credits or new market tax credits? Or
We've done very little in that. There are some projects that have viewed pieces of them. We're doing a ground up deal in New Jersey, actually, that is utilizing every single kind of credit that there is available. But yeah, I would say, we are primarily focused on lowercase affordable and uppercase affordable with 4% tax credits.
Yeah, and what's really wonky about an affordable deal is basically the capital stack. There's all sorts of challenges, but the capital stack is super wonky. Like in a traditional market rate deal, you might see just a few sources of capital, but in an affordable deal, you might see 10 upwards of, I've heard 15, which is nuts. But those other sources of funding are soft funding, it's NOFA funding, it's bond financing, it's all sorts of different things. So you're looking high and low for all those sources of funding for your capital stack?
Yeah, I mean, I think that the projects that are getting done right now are projects who have been able to simplify those capital stacks, who have figured out ways to use, like I said, recycle bonds, B bonds that are getting issued, 501c3 bonds, where you're trying to reduce the number of pieces of financing that are required, because again, they create complexity, and complexity creates timing issues as well as high costs to those projects.
Yeah, and it's worth mentioning that these projects typically come with covenants. So you have to maintain affordability at a certain AMI level or you lose your tax credits. So maybe explain a little bit about that.
Yeah, so
the compliance periods, the 55 years.
Yeah, they're, with tax credits, there is a 55 years, but the credits are sort of monetized over a 15-year compliance period. So we're doing a bunch of deals that are actually getting close to their year 15 compliance period, and we're coming in and doing a re-syndication where we're applying for the projects need an infusion of capital, they need to be renovated. That equity investor has pretty much been paid out. It's going to revert to the ownership of the developer, but there's no more cash for those renovations. And so we're going in and reapplying for tax credits as part of an AC rehab strategy.
Yeah, you mentioned AC rehab, and a big push in the industry for affordable is this, what we call natural occurring affordable housing, or, the idea is that older stock will filter down and become more affordable, but because of investors like Eddie, who suck those A and B, C and build buildings up and repurpose them. But maybe talk a little bit about your efforts on preservation in particular and AC rehab. It's probably something that these folks have not heard about before.
Yeah, I mean, preservation, we have a bunch of deals that we can put covenants on. So that's affordability covenants with long-term deed restrictions. So we're saying depending on the regulatory agreement, but say it's a 30-year, some new agencies are coming out with 10-year deed restrictions. And we're saying if you are going to maintain these properties at these AMI levels, then we can give you an incentive. So like I said, in California, one of those big incentives is the welfare tax exemption, where you are able to remove the property taxes from, these are privately financed, and they're preservation deals. And, the hope is that incentive is used to be able to maintain rents at these affordable levels, as well as invest back into those assets with the proceeds that would have otherwise been part of that property tax revenue.
Yeah, the only tool that I've heard that working pretty well for middle income is the tax abatement. Mm-hmm. So you need some sort of the issue with California in particular, and most major metropolitans across the country, is that the land costs are so high, you really can't make affordable pencil. The only thing that works is luxury, and that's why you see all the new construction in the city of LA, that you see all the cranes and towers. It's mostly a luxury product. There's just no way to do affordable without some sort of subsidy.
Well, we are building privately financed affordable housing. We're doing modular construction. So it is happening. I have 3 assets that are almost completely out of the ground in West LA. We have tie-ins with the VA, where we're going to be able to put tenants that have vouchers through the VA there, and walking distance to the resources that they need at the VA. So it is happening. Is it happening at the rate and at the speed that we would all like? No.
And now we're going to have public transit going to the VA too, which will stop at UCLA, and the last stop is at the VA for now. Yeah, it's a tough conundrum. I mean, the good news about tax credits is that they seem to be LIHTC. It seems to be nonpartisan.
It is a nonpartisan.
Republicans like them because it creates incentives for developers, and Democrats like it because it provides housing for folks too. So probably a safe product for now, in the foreseeable future.
Yeah, I think that LIHTC is here to stay, and you can debate on whether it's a good program or not, but it is the program that we have. And as a country, we funnel billions of dollars every year into LIHTC, and it is responsible for building housing that is desperately needed at lower AMI levels that could otherwise not be built.
It's a great product. The issue is that it's finite. There's not a lot of it, as you mentioned. And if we really want to attack the housing issue at scale, I think we need private sector solutions. And there are several people that are working at that. One of the stipulations for taking tax credit financing is that you have to use things like prevailing wage and union labor, which drives up costs. And so that makes it untenable a lot of times. Most market rate developers I know will look at the way you do affordable and say, I've learned one thing, I'm never going to do an affordable project. It's just too difficult. But I think some of it, you did mention that maybe, I think you have like one home key project that you're working on.
We have a few home
So
key
that's a
projects.
program where we're actually taking homeless people off the street and putting them in. I mean, you may have heard that they were taking down hotels and things like that. And a lot of the affordable housing developers have gotten into that space as well. But I think, do you have one project? And
We have a few. We actually closed on one this morning.
In California.
In California. So that is a motel conversion using home key funds. But again, the life cycle of those deals is long.
Yeah.
And costly.
Yeah, absolutely. And in terms of innovation in housing that could potentially drive down cost, you mentioned a little bit about this, Jamie, but Oscar, you probably follow this too, but ADUs, the ADU market, has that driven down affordability in California? The use of modular, what sort of technological innovations have we seen come into the marketplace that may drive down costs?
We have been seeing, last few years, something increased in, building of ADUs. Now, we all know probably, the construction process actually takes a long time. So even though, we have been seeing some increase in permits, the process is kind of slow. It hasn't really helped, it hasn't really made a dent in terms of, increase in supply to the housing market. But at the same time, of course, we're seeing, some fluctuation in demand as well. So I think we'll continue to see some increase in ADUs in the upcoming, let's say the next 6 months or a year or so. But it all depends on where the economy is going, and how the finance situation is doing in the finance market.
Yeah. Here at UCLA, at the Ziman Center, we actually released a study a couple of years ago, and it looked at it's a data-driven research project on where the sort of kinks in the hose are in delivering product. It's all across the board. Utilities are a big one. Permitting is a big one. The average apartment building in the city of LA takes almost 5 years to deliver.
Yeah.
And it takes 1 or 2 or 3 in other states. So we've got this acute housing crisis. And if it takes us 5 years to build one apartment building, I mean, that is just not going to get us to where we need to be anytime soon.
And at the same time, of course, the macro environment, if you see the cost of material and building actually, jumped.
Yeah, construction costs are way up, labor costs are up, and the other sort of geopolitical shock, are tariffs on or tariffs off, there's lumber, steel. I think 70% of our lumber comes from Canada. And if we decide to slap a 25 north, tariff on lumber, that's going to obviously have an impact on your ability to control costs and build in California too.
Yeah, I think that's the reason why some of the builder sentiment that we have been seeing have gone down a little bit. We just need a little bit more certainty. I mean, regardless of whether, interest rates are going to go up or down, without certainty, it's really hard to predict.
And that's what we're lacking in the marketplace right now too. So for any of you, have you seen any impact of remote work on the housing sector at all? I mean, obviously we see more people at home. It's obviously impacted the office sector. I mean, downtown LA right now is hollowed out completely. But does that factor in any of the way you think about investing or forecasting markets?
We do look at, we have maybe about 5 years now of, people working remotely. I think when we look at the trend, we follow, the remote working trend. It seems like, it has plateaued a little bit. Used to be at one point, maybe about 30% of the people work from home, but then.
Will they look for an extra bedroom because they're looking for an office or?
Right, and building a little bit bigger size of home. We actually asked specific questions in our survey. We got a lot of responses the very first couple of years. And of course, in the last couple of years, things actually died down a little bit as far as the plateauing. And of course, the labor market is not doing as well as before.
Yeah.
So people may not necessarily have that leverage of working from home as compared to before. So you asked me earlier, Tim, about, whether the Inland Empire is actually doing well or not. I think early part of the 2020, 2021, 2022, they were actually doing pretty well because they have the ability, people have the ability to work away from, let's say, central LA. And then they buy something a little bit more affordable. But then when the labor market actually shrink a little bit, People have to work 4 days a week, in the office. It doesn't make any sense for them to actually drive, 2 hours, 3 hours, to.
Yeah, we definitely have this job work home imbalance in California where people are moving further out for affordable housing and then have super commutes, like 2 hours
I
each
know.
direction. And you think about quality of life and all that. And now with gas costs, I mean, my
Oh, yeah.
gosh. That's why I think we've seen a lot of building in the Inland Empire. I drove through there last year. I couldn't believe the number of master plan housing developments that are building out in San Bernardino and Riverside and all of that. And I guess they need job growth too. I mean, I don't know where the jobs are coming from that Inland Empire.
I think it's getting a little bit better in terms of the economic growth in Inland Empire. Someone in the room probably already remember back in 2004, 2005, we had a significant increase in home buildings in Inland Empire out of nowhere. And of course, that was overbuilding. But I think in the last 5 years or so, we might be building a little bit more in Inland Empire, but that's partly because people can work remotely. And we're seeing a little bit more economic growth in those areas. Probably just a little bit more, not a significant increase.
Yeah. And then like Elizabeth, I have to ask the obligatory AI question. Any of you guys using AI in your work at all? Or I mean, and how?
We're trying to automate many of our systems. We deal with a ton of compliance as a nonprofit partner too. And a lot of that is repeatable tasks. And we are looking at all ways of sort of leveraging it. Additionally, within affordable housing, the winds change when you're trying to cover a national landscape of what affordable housing we had a program that we were utilizing in South Carolina for the last 4 years. That was a great program. It shut down overnight. And so trying to keep on top of these trends, and they're very local, we're utilizing a lot of AI to be delivering, really news and research.
Oscar, in your financial models or anything else?
Doing that.
You are, yeah.
Yeah. So I have Claude.
Yeah, so do I.
He's great.
Claude's my friend.
The thing is, he's a little bit too friendly to me. So I'm like, hey,
That's TMI. That's TMI, Eddie.
A lot of good catch. Like, oh wow, good. I'm glad you thought of that. It's like, yeah. Here's my 2 cents on AI. Especially, I have my entire underwriting model. My Claude prompt is 20 pages. And I'm still refining it. It actually does work. But what I'm kind of really understanding and learning is that once you work with the AI engine to get it into the Claude model, so if you're working with, a newly minted MBA, that might be 2.5, 3 hours. Working with the Claude system and all the checks and balances you got to do, maybe that's an hour. So you're saving a little bit of time. That's great. But importantly, it's what you do with those other 2 hours. And the other 2 hours are now spent on real brain work, real thought, and human ingenuity. And so that's where I'm going with all of this. I like to tell people that it's like, okay, so I'm this smart. Lately, I've been kind of drifting in my late 50s into this smart. Claude's going to get me back to where I used to be. Not that smart. I'm not going to go up here. That's not going to be me and Claude. I'm going to get to this level, and it's going to be great. But I'm going to have actual, sort of people around me that can help navigate deals and whatnot, and really kind of be as smart as we are.
I think most people will say it creates efficiencies, and so maybe the productivity will go up too. How about the bank? And anything you guys just?
Yeah, I mean, it's helping definitely for efficiency of getting things done quicker, right? I know we use AI for forecasting. That's not really my area of expertise, but we're using it just from the consumer level to, instead of closing a loan in 30 days, we can close it in 15.
Yep. So I had the challenge of trying to do an hour panel in 45 minutes, and I think we've sort of done it. In fact, I have a couple of minutes left over for any questions from the audience at all. Yes, Ron.
If you can hear me, incredible information. Thank you. Jamie, for you on the affordable. Are you still seeing, in addition to all of the hurdles, the spatial requirements from these sources of money in these units? We've toured micro units in Detroit that were less than 300 feet, and they were great. You can't do that from what I understand with a lot of the regulations in place. Is that changing? Is there any hope for that to change? And what would that do if it did change?
I think that some of it will change. Those rules and regulations are there to protect, honestly, renters and what they're getting for their units. For like, you come with a voucher, what are you getting for that? So yes, I think some of them will change, but it's going to be slow.
The issue with LA in particular is that we're 73-4+% still zone single family in the city of LA. And we obviously, that was fine when there were 3 million people in the LA County, and now there's 10 million people in LA County. And we really need more density and verticality. And of course, there's huge community opposition to doing it. The NIMBYs are out in force in the LA. And it makes it very difficult to build density, and even more challenging for the product that you build, Jamie, because not only do they not want the density, they don't want the people that are going to be living in there. Like, nobody wants affordable tenants in their neighborhood. And it's just, these buildings the buildings you build, you cannot tell the difference. I mean, they are really beautiful.
Yeah,
and a lot of the product, a lot of your product comes with, social services attached, and they have counselors, they have all sorts of treatment activities. And
I think that, we have a real lack of supply on family affordable units. And so to your point on sizing, like, we can't just be delivering micro units. We need families to be able to move into units and grow. And so, we are cognizant of that, and we want to support seniors to be living in more than 300 square feet.
Yeah, the reality is we need more housing at all levels in California and Los Angeles. We just, everything from transitional homelessness all the way up to the workforce, and we're just lacking supply across the whole spectrum. Any other questions? Yes, one back there. Yep. Oh, here we go.
Hi. Yeah, sorry. So I know a lot of people think a large reason why the measure ULA, or the mansion tax, whatever you want to call it, reason why it is like detrimental to projects like the affordable housing projects is because it is a flat tax. For Jamie, do you think there's a way this tax or future taxes could have been designed in a way that still brings in the revenue dedicated to affordability that you need, but doesn't necessarily hurt your projects?
Well, I mean, we're talking now about amendments to this to carve out affordable housing, which I think will help. But, there are lots of problems, I think, with ULA that I won't be able to fully address. So I'll just speak to it from the affordable perspective. I do not think that you can have this tax on affordable housing projects.
Yeah, there's a move to exempt 100% affordable projects, which I think I would be supportive of. And yeah, it's the issue, and we did another study through our center, but it's pretty much quelled multifamily development in the city of LA. It's been decimated. There's not a lot of new construction. And if you compare the county of LA is made up of 88 independent jurisdictions, the city of LA being the largest. And if you look at all the adjacent cities around the city of LA, their production hasn't dropped at all. So you have to point to ULA as being the issue. So any other questions at all? No? Wow. I think the bells are ringing from this also. Well, thank you. And please, thank the panel here for their contributions. We'll appreciate it. And I think Clement is going to give a few words of closing.
So I'd like to reiterate what Sebastian said earlier about how wonderful a conference has been today. So we'd really like to thank the speakers again, all the way from William here at the Forecast, to Spencer at Alan Atkins, to Elizabeth Brink coming with her speech from Gensler. I mean, I wish we had had another half hour to listen to you, and I'm sorry we didn't have time to answer questions because that was wonderful. And then last, we'd like to thank Tim Kawahara and the great panel he put on for all these technical details of the real estate market and the different dimensions of it. So thank you, Tim. And then lastly, we'd also like to thank all our wonderful sponsors here at the UCLA Anderson Forecast. So at the principal level, we have RSM and Yamava Resort and Casino at San Manuel. At the platinum level, we have the law firm of Alan Atkins, Cathay Bank, Federal Home Loan Bank of San Francisco, Mercury Insurance, and the University Credit Union. At the gold level, we have Alaska Airlines, Bank of California with a C, Hub International, Leap Development, Numo, PNC Bank, Robert Half, and SMC BC Manu Bank. At the silver level, we have Marcia McLennan Agency, McCarthy Cook, U.S. Bank, Private Wealth Management, and Wilmington Trust. At the bronze level, we have Active Security, Citizens Private Bank, Columbia Bank, Gensler, Hanmi Bank, HCR, MBK Real Estate, the Port of Long Beach, Q2, and Shawmut Design and Construction. And then lastly, at the Bruin level, we have GCX, JLL, and Suffolk Construction. So that ends our conference today. Thank you all so much for attending, and we hope to see you again at the next one at the end of September or start of October.